हाँ सर मैं पूछता
हूँ। आ रही है आपकी आवाज आ रही है?
हाँ
ओके थैंक यू मैम। ये प्रेजेंटेशन
Sir, from Canara Bank, sir. Sir, audio clear?
Canara Bank audio clear, sir.
Oh, thank you, sir. Thank you, sir.
Good morning. Am I audible? Very good morning. Good morning
Yes, sir,
to
audible,
everybody. Audible? Okay. Thank
Yes,
you.
sir. Audible. Thank you.
Thank you.
Hi, am I audible?
Yes, I can hear you.
Thank you so much.
So joining from Mr. Tapan Singhal's office, can you hear us?
You're audible. Yeah.
Namaste. Shreyas Jayasuma, Arna Law, checking if I'm audible, please.
Hello.
Yeah, this is C. Anantha Nageshwaran, dialing in from Tokyo. I will be speaking in the place of Secretary Economic Affairs Ajay Seth at 11:15 at 11:30. Hello. Hello, can you hear me?
Anand, I can. This is Janmajay, but everyone hasn't joined yet.
No. I think it's quite early. I just dialing in just to make sure that my Mac is working. So 11:15, I will be there. Yeah.
Good morning, sir. We are from Sarsai. Are we audible?
You are audible. Am I audible and visible?
Yes, sir. Thank you. We are audible.
Yes. Are you able to see me?
Yes, you are
visible as well.
Good morning. This is from MCA. Are you able to listen to us? Whether we are audible?
Jagannath from LIC.
Yeah, please confirm. Audio video clear? Corporate affairs?
Yes.
वीडियो कहाँ दिख रहा है अभी? Audio video clear, sir? Hello.
Hello.
Please confirm audio video clear from corporate affairs.
Yes, we can hear you.
Good morning, sir. Canara Bank. Are we audible?
Get a response from the other client, sir. Yes, sir.
Hello. Yes.
Are we audible?
Good morning, sir, from Canara Bank.
MCA?
Yes. Yes.
We are audible, sir.
Audible. Canara audible.
Oh, okay. Thank you.
Good morning, I'm Madan from Bank of Baroda. I hope I am audible and also visible. Good morning,
yes,
everyone. I am Madan from Bank of
you are
Baroda.
visible as well as audible to me at least.
Okay, thanks a lot.
Good morning.
Good morning. This is from MCA. Secretary MCA's office. I would like to know whether you are able to hear us or not. Please confirm.
Hello, sir.
Yes, sir, you are audible.
Okay, thank you. So I'm
Good morning. This is Sripal Shah from Kotak Securities. Am I visible and audible, please?
Yes, sir. Audible and visual, sir.
Thank you. Thank you.
Good morning. It's Manoj Kumar Gupta. I am an advisor in Ministry of Agriculture. Can you confirm whether I am audible and visible too?
Yes, sir. Audible and visual, sir.
Okay, thank you.
Good morning, Nipa here from Trust Group, SHM, representing SHM. Just confirming clarity of voice and visibility.
Hi, good morning. This is Navneet Punot representing MP. Hope I'm audible and visible. I can see Nipa and hear you. I hope you can.
I can too. So I guess things are okay.
Right.
Yeah, Nipa and Navneet, we can hear you and see you.
Thank you.
Thank you. Looking forward to
Hi, good morning. My name is Survi Goyal from Munich Re, India. Just wanted to check if I'm visible and audible.
Yes.
Thank you.
This is Rajiv Verma from Samsung. Just want to check if I'm audible and visible.
Audible and visible, sir.
Good morning, this is Jagannath from LIC. Okay. Hello?
Hi, this is Ashish here from CRISIL. Am I audible and visible? Hello?
Hello, I'm Dhruv Sengupta from JS from DOPPW. Am I audible and visible?
Yes, sir, you are.
You are audible.
Thanks.
And visible.
Hi, this is Vibha Padalkar. Good morning. Hope I'm audible and visible.
Yes, ma'am. Audible.
Yes.
So, good morning, sir. This side Onkar from Corporate Affairs. Please confirm audio video clear.
Yes. Clear.
Thank you.
Hi, this is Ashish again. Can I get a confirmation if I'm audible and visible?
Yes, Ashish ji, you are audible. Can see you.
All right, thank you.
Hi, good morning. I'm Manish Bharadwaj, DDG UIDI. Am I audible?
Yes.
Unmute.
NIC headquarter. NIC
Yes, sir.
headquarter.
Yes, sir.
Audio and video clear, sir, from Dak Bhavan.
आ रही है डाक
Yes,
भवन आपकी
sir.
आ रही है
आ रही है, सर?
आ रही है मिनिस्टर ऑफिस MOS
Hello.
फाइनेंस
MOS Finance Office.
आ रही है आपकी आवाज आ रही है
सर क्लियर आ रहा है मेरा वीडियो?
हाँ क्लियर है अजय जी बात कर रहे हैं
जी जी
हाँ आ रही है
ठीक है सर, थैंक यू।
morning. Myself A.K. Goyal, ex-MD and CEO of the PNB. Am I audible and visible?
Yes, sir, you are audible and visible. Good morning, sir.
Thank you very much. Thank you.
Hey, hi, Parul. Just checking if you're on.
होता है तो 11 बजे माइक चेक करते हैं, फिर साउंड नहीं चलता है. Look at the way the events or the IT and the admin teams are working as one team, and making sure that it is all ready. The business person has to come in last.
मैंने एक फॉर्मेट भेजा. हेलो, प्लीज म्यूट ऑल द पर्सन, म्यूट द माइक प्लीज.
DFS,
पीपीटी हटवा के बात करना.
DFS please.
Yes, yes, please.
एक बार PPT बंद करेंगे please.
ओके प्लीज.
इसमें ले आओ, तुमको इसमें ले आता हूँ.
सर अभी प्रधानमंत्री ऑफिस आपसे बात करेंगे, 1 मिनट लाइव रहिएगा.
ओके.
तो जो एक बार और कैमरा थोड़ा जूम इन करेंगे.
अच्छा,
क्योंकि सेक्रेटरी साहब इसको एंकरिंग करेंगे तो उस पे
राइट. और वो
ऊपर
आप करो थोड़ा, आप करके. वेरी गुड, वेरी गुड. हाँ, डाउन डाउन. आप जूम इन कर दिए. जूम इन बस.
एक स्टेप जूम करिए.
जूम इन कीजिए.
सही है.
एक स्टेप जूम
और जूम इन कीजिए. और जूम इन कीजिए. और करो
प्लीज.
और कीजिए. और
राइट. अब देखिए.
और कीजिए. अब अपने कैमरे को उधर ले जाइए, आपके राइट में ले जाएं. ज्यादा हो गया.
इज इट ओके?
हाँ, अभी PMO आ रहे हैं, इसमें 2 मिनट दीजिए.
सर को बुला लीजिए. सर को, सेक्रेटरी साहब को.
नहीं, आप
ओके.
It's for rehearsal.
अभी प्रेजेंटेशन कोई नहीं चलेगी.
संजय सर, ऑडियो आ रही है?
हाँ, मेरे पास आ रही है आवाज.
आवाज आ रही. हेलो,
इसमें आवाज नहीं आ रही.
हाँ, बोल रहा हूँ.
डिपार्टमेंट ऑफ
DFS, मेरी आवाज मिल रही है आपको?
हाँ.
हेलो
सर मेरी
हेलो,
आवाज
आवाज आ रही है आपकी?
मेरी आवाज प्रॉपर मिल रही है
बिल्कुल
सर आपको?
आवाज मिल रही है।
और
यस
वीडियो मिल
यस
रहा है आपको?
यस, वीडियो भी मिल रहा प्रॉपर।
ऑडियो वीडियो प्रॉपर मिल रहा है?
यस।
थोड़ा हमिंग है।
सेक्रेटरी साहब यहीं से बोलेंगे?
हाँ हमिंग है हमिंग।
हाँ यहीं से बोलेंगे।
ठीक
यहीं
है
से
सर,
बोलेंगे सेक्रेटरी
माइक से आप एक बार ऑडियो चेक करवाइए, 1 to 10 काउंट कर दीजिए प्लीज।
इसको बंद कर दो। हाँ बात कर पाएंगे।
हाँ सर, एक काम करिए सर, आप जो सेक्रेटरी साहब का चेयर है थोड़ा सा मूव करके आप सेंटर में आ जाइए सर, एक बार
माइक पे
जी जी।
अब 1 to 10 काउंट कर दीजिए प्लीज।
यस। 1 2 3 4 5 6 7 8 9 10।
सर स्लो, 1 2 3 इस टाइप से सर प्लीज।
1 2 3 4 5 6 7 8 9
ठीक है,
10।
थोड़ा अप डाउन है सर उसमें ऑडियो में।
सर एक बार ये माइक चेक कर रहे हैं। सर जो आपका फ्रेम है इसको हम जूम इन कर लेते हैं, ऊपर का लोगो हटा के भारत सरकार से एक फ्रेम बना लेते हैं। ये भी बहुत ज्यादा हाँ सर, एक बार फ्रेम बनाए सर। यहाँ पे सिंगल सर को सिंगल ही बैठने हैं?
यस सर, तो सिंगल बैठेंगे।
ठीक है, तो मेरे को एक बार फ्रेम आप करवा दीजिए, थोड़ा जूम इन करवा दीजिए और टिल डाउन करिएगा प्लीज। हाँ, और टिल डाउन करिए, ऊपर लोगो हटा देते हैं सर, भारत सरकार से ले लेते हैं। अब डाउन करिए। हाँ
थोड़ा बस ठीक है
सर, एक स्टेप और ऊपर हो जाए तो। नहीं सर, एक बार जूम आउट करिए तो सिर्फ लोगों के साथ आ जाएगा वो स्टेप। जूम आउट करिए सर एक स्टेप, बस। सर ये वाला फ्रेम रख लेंगे, थोड़ा सा पेन लेफ्ट कर दीजिए, सेंटर हो जाएगा ये। वन साइड में एक तरफ वॉल ज्यादा दिखाई दे रही है ना? नहीं, दूसरी ज्यादा हो गया सर। ठीक है सर, आप क्या इसमें फ्लैग भी लगाते हैं? फ्लैग साइड में मुझे दिखाई दिए।
हाँ फ्लैग है, दोनों साइड है।
तो लगवा दीजिए सर, इस साइड में ले आइए, थोड़ा अंदर पुश करवा दीजिए फ्लैग को।
ओके ओके।
और चेयर सर एक ही रहेगी ना?
हाँ राइट, चेयर एक ही है प्लीज।
हाँ ठीक है, नहीं बिल्कुल बोर्ड के कॉर्नर पे। हाँ और हाँ ठीक है, ये सही है सर।
बोर्ड के
ये ठीक है, ये ठीक है सर, ठीक है। हाँ इधर वाला थोड़ा पुश करिए, सर्विस पे एस पे आ रहा है। ठीक है सर।
अब ठीक है
इस फ्रेम सर, जब सेक्रेटरी साहब बोलेंगे तो ये वाला फ्रेम रख लेंगे अपन।
ओके ओके
ठीक है सर। आपके फेस पे लाइट बहुत ज्यादा आ रही है सामने से कोई।
ओके
ठीक है, ऑडियो तो ठीक है ना?
नहीं अभी 11 बोलेंगे। हाँ
ये थोड़ा सा आगे पीछे हो रहा होगा अभी।
एक अब सेक्रेटरी
ये इनका ये कौन है? एक मिनट, ये क्या है? अमित सर, इनकी वीडियो अभी फ्रीज हुई थी।
सर बताइए।
अमित सर, इनकी वीडियो भी फ्रीज हुई थी।
वो चेक कराता हूँ सर, मैं कोई नहीं, मैं उसको बोलता हूँ।
अभी भी हुई,
अभी भी फ्रीज हुई है सर, फ्रीजिंग आ रही है आपके वीडियो में। अभी फिर दोबारा हुई है सर, नेटवर्क चेक करवाओ वहां पे। अमित सर
ओके सर ओके।
हाँ, सेक्रेटरी ऑफिस
म्यूट है सर।
यस,
मेरी ऑडियो मिल रही है सर? अभी जब हम शुरू ये प्रोग्राम
ऑडियो भी मिल रही है, वीडियो भी मिल रही है।
ठीक है सर, मैं आपको एक क्यू पॉइंट बता रहा हूँ। जब प्रोग्राम शुरू होगा तो आपको स्क्रीन के ऊपर एक टेक्स्ट प्लेट दिखाई देगी जो आपका आज का सब्जेक्ट है।
यस।
तो वो टेक्स्ट प्लेट का मतलब है कि पीएम साहब रूम में आ गए हैं और आप स्टैंड बाई हो जाइए। जैसे ही वो टेक्स्ट प्लेट हटेगी, पीएम साहब दिखाई देंगे, से इमीडिएटली फिर जो भी सेक्रेटरी साहब को वेलकम करना है।
ओके।
और सर लास्ट में जब धन्यवाद करेंगे तो हम आउट हो जाएंगे, वही जो फर्स्ट प्लेट हमने दी थी वही प्लेट लेके। उसके बाद आपका यहाँ से थैंक यू नहीं है। ठीक सर?
ओके।
हाँ अमित सर, वीडियो फ्रीज हो रहा है इनका। और सर एक बार ऑडियो चेक दोबारा और करवा दीजिए प्लीज।
DFS?
हाँ प्लीज
सर
हाँ
आप
बोलिए।
यहाँ पे IP PC सिस्टम लगा हुआ है आपके यहाँ?
DFS में भारत पीसी का लिंक कौन सा?
आप लाइट ठीक है देखिए प्लीज अशोक जी।
हाँ सर बताइए।
लाइट चेक कर लीजिए आप, ठीक है?
हाँ लाइव।
सर अभी बीच बीच में पैच आ रहा है। अगर आपका यहाँ पे BC सिस्टम लगा हुआ है सर?
10-23-112 का 110 वीसी सिस्टम ही पूरा चल रहा है प्रेजेंट।
सर अभी लाइट कम हो गई है, फेस पे लाइट बहुत कम हो गई है।
अच्छा लाइट हेलो
हेलो ये जला दीजिए, ये ठीक है।
हेलो सर ठीक है ओके ठीक।
एक
मिनट हेलो सर।
सर
हाँ,
एक
बोलिए।
चीज कह रहे हैं सर, ये साइडों में क्या पेन रखे हैं, एक बार हटा लेंगे इनको। माइक रखे हैं, यहाँ पेन रखे हुए हैं।
हाँ
5, 6
हाँ अब देखिए अब कुछ नहीं है। यस पेन था।
ऑक्स 5 पे
सर मैं जो आपको टैक्स प्लेट है वो आपको दिखा रहा हूँ, ये आपको जो मिलेगी ये टैक्स प्लेट आपके लिए क्यू पॉइंट है।
ओके
ठीक है सर? सर
ठीक
मेरी
है।
आवाज मिल रही है? ये टैक्स प्लेट आपके लिए
हाँ
क्यू
आवाज
पॉइंट
मिल रही है।
हाँ ये टैक्स प्लेट
जी।
आपके लिए क्यू पॉइंट है। इसका मतलब पीएम साहब रूप में आ गए हैं। ये टैक्स प्लेट जैसे ही हटेगी पीएम साहब दिखाई देंगे और इमीडिएटली वेलकम करना है। तो ये टैक्स प्लेट आपके लिए क्यू पॉइंट है।
हटा दो।
ओके
ये इसके बाद ये ऐसे दिखाई देंगे। सर ये आपके लैपटॉप के आगे ये क्या है, मतलब एक ब्लैक रंग के जो है
स्टिक
क्या
है।
स्टिक से क्या है, ये पेन है क्या है? ये लैपटॉप के
These are
आगे
the table tops. These are the table tops. इसको बंद कर दे रहे हैं।
ओके 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 ठीक है, मतलब हमें स्टिक दिखाई दे रही थी। ठीक है सर। ओके सर ये रहेगा पैटर्न। अमित सर वीडियो
Okay.
फ्रीज हो रही है इनके यहाँ की।
सर
सर मैं
इनका थोड़ा
चेक
सा
करवा रहा हूँ
माइक
सर नेटवर्क में। हाँ मैं चेक
अमित
करा रहा हूँ
सर अमित सर
जी। हाँ जी सर।
सर इनका थोड़ा माइक का गेन बढ़वा दीजिएगा।
आपको मैसेज करेंगे। हाँ बोलो।
जैसे भी हो रहा होगा।
हेलो
संजय जी।
बोलिए।
हाँ
सर
सर
बोलिए।
बोलिए।
अच्छा उधर, अच्छा एक DFS आप एक बार अपने रिमोट से
हाँ,
डिस्कनेक्ट
बोलिए।
कीजिए। आपको डायरेक्ट अपने ब्रिज में ला रहे हैं, तारीख पॉइंट टू पॉइंट। एक बार डिस्कनेक्ट कर दीजिए वीसी, सिर्फ आप अपने को डिस्कनेक्ट कीजिए
सुधीर
और अपना आईपी एड्रेस बताइए। आईपी बता दो एक बार, फिर डिस्कनेक्ट करना।
ओके आईपी
तुम यहाँ से डिस्कनेक्ट कर देना।
10-23
सुमित पहले आईपी बताइए।
10-23 112 का 110 एक मिनट मिच करा ली
एक बार हम पूछ लेंगे उनसे।
मेरी सुमित है सुनिए
हाँ लाइव में बात करो ना।
आईपी
अब बैठ जाओ पारुल।
हाँ जी you can see him. Should we speak something? बता दीजिएगा प्लीज। ओके ठीक है।
अमित सर ये जो एक साइट और हमें आप दिखा रहे हैं क्रेडिट वाली सर्विस
जी सर।
क्रेडिट, ये क्या है, इसमें क्या इनका क्या रोल है?
ये सर वो रहेंगे वेबिनार में उसमें।
अच्छा तो इनका
हाँ।
कैमरा थोड़ा नीचे करवा दो सर। यदि फुल फ्रेम आप दिखाए दो तो ऊपर एसी बहुत दिखाई दे रहे हैं। मेरी बात होती है सर?
वो सामने जो पोस्ट वाले जो
पोस्ट वाले हाँ
एक बार बोल देते हैं डिपार्टमेंट ऑफ पोस्ट। सर आप सुन पा रहे हैं? नहीं मैं तुम देख लो अगर मिल रहा है तो।
सुन रहे
हाँ सर ये जो आपका कैमरा है इसको थोड़ा सा डाउन कर लें डिपार्टमेंट ऑफ पोस्ट वाला, तो वो पीछे जो एसी के शो हो रहे हैं वो अजीब लग रहे हैं। थोड़ा सा डाउन कर लीजिए प्लीज।
और सभी अपना कैमरा ऑन रखें प्लीज।
हेलो
हेलो
सेक्रेटरी साहब
हेलो हेलो
मैं दोबारा अभी तो दोबारा
हेलो
दिखा सकता
हाँ
नेट को, मैं बात कर लेता हूँ।
हेलो हेलो सर, अभी ये दोबारा प्लेट के लिए कहेंगे,
डिपार्टमेंट
मैं
पोस्ट
बताऊंगा।
सर आईपी एड्रेस इज 10.20.
अमित सर,
सर
डिपार्टमेंट ऑफ पोस्ट में भी आपकी फ्रीजिंग आई है अभी।
वो एक बार अगर डिपार्टमेंट पोस्ट से है कोई, एक बार प्लीज रेस्पॉन्ड फ्रॉम देयर डिपार्टमेंट पोस्ट। सर वो जो पीछे जो एसी का व्यू आ रहा है ना, वो थोड़ा सा कैमरे को आप नीचे डाउन करेंगे तो वो एसी का व्यू हट जाएगा। पीछे ना आपका वो देखो, पीछे दोनों एसी आ रही है।
संजय जी,
हाँ
जी,
सर
अभी आप
बोलिए।
चेक करें, डीएफएस को हमने डायरेक्ट लिया है इधर।
ठीक है सर। हाँ, थोड़ा टेल डाउन कर दीजिए सर, डिपार्टमेंट ऑफ पोस्ट थोड़ा सा टेल डाउन कर दीजिए कैमरा, जस्ट ऊपर का। हाँ, ज्यादा हो गया सर।
बस कट के चला गया। बहुत नीचे कर दिया थोड़ा सा।
ठीक है, छोड़
बस ठीक है।
डिपार्टमेंट ऑफ पोस्ट ठीक है सर, थैंक यू। नमस्कार सर, सेक्रेटरी ऑफिस, सेक्रेटरी साहब नमस्कार।
डीएफएस प्लीज रिस्पॉन्ड करें। डीएफएस प्लीज रिस्पॉन्ड, डीएफएस।
डीएफएस, मेरी आवाज आ रही है आपको?
या
डीएफएस।
हाँ बोल रहा हूँ।
हाँ, नमस्कार सर।
या
नमस्कार।
नमस्कार।
नमस्कार नमस्कार।
हाँ सर, मैं आपको एक जो टैक्स प्लेट है वो दिखा रहा हूँ, वो आपके लिए क्यू पॉइंट होगी। वो जब पीएम साहब आएंगे तो उससे पहले हम आपको टैक्स प्लेट देंगे, वो जैसे टैक्स प्लेट हटेगी तो पीएम साहब दिखाई देंगे, तो तब से वेलकम करना। मैं आपको टैक्स प्लेट एक मिनट डिस्प्ले पे दिखा देता हूँ, ये आपके लिए क्यू पॉइंट होगी सर।
ओके,
टैक्स प्लेट दिखाओ सर, ये टैक्स प्लेट आपके लिए क्यू पॉइंट होगी सर। ये जैसे ही हटेगी पीएम साहब आपको इसमें दिखेंगे स्क्रीन पे। ठीक सर?
ठीक है।
थैंक यू सर।
थैंक यू थैंक यू।
संजय सर आपको वापस ले चल रहा हूँ, ठीक है?
ओके, ठीक है।
हेलो अश्विनी। अश्विनी
Till 12:30. Why?
माइक ऑन हो गया, माइक ऑन हो गया. Presentation.
Sir, you can start.
Good morning, everyone. Respected ministers and my senior colleagues to Government of India and senior officers, and also the respected panelists and CEOs of private sector and chairmen of private sector companies, academicians, everyone, on behalf of Government of India and for the Team 7, extend a very warm welcome to all of you for this webinar on regulatory investment and ease of doing business reforms on the theme. So now I will first of all explain the formats, and thereafter I'll make a small presentation on the matters relating to financial services. The whole program is divided into 3 separate sessions. One is between 11 o'clock to 12 o'clock, where the senior officers from the ministries and the departments from DEA, Revenue, DPIIT, MCA, Department of Post, Niti Aayog, will give a brief thematic background on each of the announcements made in the budget. And this will continue till 11 o'clock, 11 to 12 o'clock. And thereafter, Honorable Prime Minister will join and will give his guidance to all of us. And thereafter, as soon as the PM's event is concluded, we will continue with the breakout sessions, whatever may be the time. We are expecting that it will be concluded by 1 o'clock or 1:15, but we will immediately start our breakout sessions on 3 sub-themes separately. And there will be presentation by experts. Once the thematic discussions are completed, now experts have been requested, who have kindly accepted. They will make the summary of the discussions and way forward for each of the budget announcements made to the honorable ministers who will be present between 3 o'clock to 3:45. And thereafter, the honorable ministers will address, and then we will conclude the today's webinar on the budget announcement. Now, coming to this 11 o'clock session, this is what we are going to do. We have 7 theme announcement under the thematic session. I will make a small presentation on the themes relating to the DFS, and then we'll be requesting the Chief Economic Advisor, who will be making on the ease of access and regulatory reforms, and then Additional Secretary Revenue on the PMLA in the context of KYC simplification, and then Secretary Post will talk on the expanding services in India's post payments bank, and then Secretary MCA, thereafter DPIIT and the Senior Advisor Niti Aayog. And we are expecting to complete by 11:55. And this is the thematic session. Now with this, I will actually go to the next thing. Now, in this breakout session, there are 3 themes. One is making India investment friendly, relating to several departments, mostly to the financial sector. We have FDI and insurance sector, credit enhancement by NAFID, merger of companies, bilateral investment treaties, and investment in friendliness index of states. Then the second theme is ease of access to financial services credit. This will be led by the DFS. And third is rationalization of legal and regulatory compliances, under which both the regulatory reforms, pension reforms, FSDC mechanism, and Jan Vishwas bill will be taken up by the respective departments. Now, we all know Honorable Finance Minister had identified 4 engines of development in this budget for development of Garib, Youth, Annadata, and Nari. And the 4 engines: agriculture, investments, MSME, and exports. These are the engines which will be driving the Indian economy. Now, theme 7 has 12 parameters, paras, which we'll be discussing now. Now, first one related to is DFS, Grameen Credit Score. Now, to talk about what we have done in the Grameen area scale, Mudra loans we have actually
You are entering the meeting now.
52 crore accounts we have opened and 33 lakh crore was sanctioned for under Mudra loans in the last 10 years. And Stand Up India, we have 2.62 lakh accounts for 59,000 crore. These are all first time the entrepreneurs, and PM Swanidhi 99 lakh accounts for 14,000 crore we have sanctioned. Now, the reason behind announcing the Grameen Credit Score is that large number of people in the rural areas don't have credit history, and it's very difficult to capture. DI. And as you know, insurance penetration in India is 3.7. Global average is 7%. Density in India is $95, whereas the global average is $889. FDI in insurance sector is still now we have received 82,847. And the objective of the announcement is to unlock, as I mentioned, potential of insurance industry, surpass or reach global growth trends, enhance competition, facilitate technological advancement, improve insurance penetration nationwide, and also meet the goal of a fully insured society by 2047. Now, the other announcement in the for the DFS is pension sector reform. Now, we have broadly three major things are there apart from the government staff. National NPS is there, that has been now UPS we are going to implement from next month onwards, and then we have Atal Pension Yojana and guaranteed assured pension benefits. The guidelines we have already issued. Now it is felt, and then there are also other. There are multiple regulators as of now in the market regulating or making the pension decisions in the country. We wanted to have a forum where the different stakeholders will actually sit together and have consistency and harmony in treating the pension funds and investments, and also coming up with the new products. Now, current challenges, I think everyone knows. Now we have there is lack of maneuverability, low coverage and awareness, and lack of persistency, and then we also need to improve consumer protection. The inconsistent compliances, transparency, and grievance redressal mechanism. So therefore, we thought of setting up a forum where all the different kinds of regulators or authorities in the pension space, they will sit together for understanding each other and also learning from each other, so that the pension sector as a key pillar of development in the country can emerge in the future. The another announcement the Honorable Finance Minister made was the partial credit enhancement facility by the NAFID, National Bank for Infrastructure Development. Next, the key points are, see, the funding is required for long-term financing, and then there is also significant capital outlays and extended gestation period, and we have relatively undercapitalized debt markets in India, and we need to deepen further. And this, we want to provide this partial credit guarantee to firms who are AA rated, so that their paper is attractive to the private sector and everybody, so that they get the cost of borrowing is much cheaper with the NAFID as a backstop. Now, the other indirect objective is to deepen the bond market. The bond market, despite our long-term efforts to deepen in the country, we are still very negligible bond market we have. There is a need to develop bond market so that long-term capital will be available for infrastructure development. These are the some of the objectives for announcing the partial credit enhancement facility. Now what we expect from the deliberations as per the guidance received from the government is that we want to have a dialogue with the prominent citizens and also experts and civil society about their expectations and on the budget, and improvements required in the current framework, and suggest policy steps required, and help in finalization of schemes and programs, so that all the schemes and programs announced by the Government of India reach the intended target beneficiaries, and devise effective and transparent modes of implementation of the schemes announced in the budget for the benefit of entire country. Thank you. With these words, I think we request the Chief Economic Advisor, Dr. Anantha Nageswaran, to
thank you, Secretary Nagaraju. Good afternoon, everybody, and welcome to this webinar on the theme of investment, regulatory, and ease of doing business reforms. I'm stepping in because Secretary Economic Affairs is busy in another important commitment as well at this point. So as we all know, the current state of the world economy, considering actions taken in the last 1 month or so by the various governments around the world, both initiated actions and response actions from different countries, it is very clear that growth will come under pressure across the world. And therefore, it is very incumbent on all of us to do whatever we can to be able to sustain a mood of constructive optimism in the country. And one way people will feel optimistic about and hopeful about their growth prospects is when they are able to undertake economic activity with the least possible intrusion in terms of time requirements for compliance, inspection, licensing, etc. And therefore, more than ever, it has become important for us to recognize this aspect, and therefore execution is very important. And the budget announced by the Honorable Finance Minister under the guidance of the Honorable Prime Minister does place a high degree of emphasis on deregulation and ease of doing business. The budget focuses on 3 critical reform areas, which are the subjects of the 3 parallel sessions today. Expanding access to financial services and credit, about which Secretary Nagaraju spoke. Strengthening investment climate and ease of doing business. Enhancing regulatory efficiency and financial stability. On expanding access to financial services, I would like to draw your attention to the budget paragraphs 96, 98, and 100. On strengthening investment climate and ease of doing business, these are referred to in paragraphs 95, 97, 101, 102, and 105. On enhancing regulatory efficiency and financial stability, I draw your attention to paragraphs 99, 103, 104, 106, and 107. Each of these themes is key to achieving our vision of Viksit Bharat and, more importantly, sustaining growth rates in the coming years as well. A robust investment climate is necessary when global FDI flows are likely to be affected due to rising global risk aversion. Investment climate needs to be maintained, as that would create capital formation, create jobs, and sustain economic growth. A modern, responsive regulatory framework is a sine qua non for this to happen. It's an indispensable condition or a prerequisite to create a friendlier and favorable growth conducive investment climate. I therefore encourage all of you to actively participate, share insights, offer constructive suggestions to make these reforms impactful, practical, and immediate. The session on expanding access to financial services and credit is aimed at inviting ideas for breaking the barriers of financial inclusion in India. As you all know, last 10 years, much has been done, starting with the PM Jan Dhan Yojana, Jan Suraksha schemes, and Mudra loans. But however, given the size and scale of the country and the fact that we are still a low middle income country, much more remains to be done, and the momentum of these early landmark initiatives at financial inclusion need to be sustained. The questions before us in this regard do require active collaboration to address challenging aspects. For example, how can we leverage India Post Payment Bank's network for last mile financial connectivity? And for improving credit accessibility to the unfunded, what can be the contours of the Green Credit Score? And how do we further ease credit to the deserving citizens? How can we further simplify KYC while ensuring financial stability and minimizing fraud? These are all the questions that we need to deliberate on today and in the coming days as well, so that financial inclusion can be advanced. We have emerged as the most attractive investment destination in the world, as is evidenced in the gross FDI inflows in the last several years. But again, we cannot afford to sit on our laurels. We need to continue to focus on improving regulatory clarity, easing business operations, and make sure that the plumbing of our regulatory framework corresponds with the broad vision. Usually the vision has been on the right lines, but when it comes to execution in the plumbing, there are unintended barriers erected for domestic and foreign investments as well. We have taken the most important step in the budget by raising the FDI limit on insurance from 74% to 100%. This will help bring in more capital, competition, and innovation. At the same time, we also need to mull over the incremental policy safeguards that may be necessary so that the increased FDI benefits are available to both consumers and the economy. Infrastructure projects require long-term affordable financing. The provision of the partial credit enhancement facility by NAFID in the union budget and the decision taken for on the mutual credit guarantee scheme announced few days before the budget are both aimed at enhancing credit for manufacturing and infrastructure bonds, making them more attractive for investors. However, there is a need to consult the industry on the structure of the proposed partial credit enhancement facility by NAFID for infrastructure financing. On a similar footing, the mergers and acquisitions need to be made faster to boost economic growth. While the government has its initial thought, the idea behind including this in this thematic seminar is to listen more to the industry and shape the legal underpinnings to drive regulatory improvement even at the state level to facilitate mergers and acquisition activity so that economic efficiency is enhanced. The topic of revamping the model bilateral investment treaty, because foreign investment plays a crucial role in the economic growth and development, and we are a current account deficit country, so we need both portfolio and direct investments. The bilateral investment treaties provide a legal framework to protect foreign investments, especially for small and medium enterprises from overseas, offering safeguards like protection against expropriation and fair treatment. India signed its first BIT with the United Kingdom in 1994, and most recently 2 more bilateral investment treaties in 2024 with UAE and Uzbekistan. Foreign investments have steadily increased in India in the services sector, computer software and hardware, trading, telecommunications, automobiles, and they have contributed significantly to competitiveness and technology advancement in the country. Initially, the BITs were focused on investor protection. Over time, many countries, including India, have realized the importance of balancing investor protection with state sovereignty. The goal is to safeguard national interests while encouraging foreign investment. As with everything, it is a balancing act, and we are prepared to iterate our approach. Countries are revising their BIT frameworks to reflect modern challenges. Given that almost 10 years have passed since the last review of India's model BIT, and since then the global investment ecosystem, international jurisprudence have evolved significantly as well. Investors now seek stronger protection for their investments, especially in emerging economies. And therefore, these developments have led to the decision to revise and update India's model BIT to align with international norms while ensuring the country remains an attractive investment destination, especially for medium enterprises coming from many advanced economies. The new model BIT, therefore, will be more attuned to the demands of a dynamic global investment environment. At the same time, we will reflect India's sovereign rights and the importance of regulatory space so that public policy priorities are not constrained by international legal obligations. I hope that today's discussion will lead to constructive insights and suggestions on how we can update the model BIT to be able to strike and maintain this delicate balance and further encourage investment in India. Coming to financial sector regulations, there cannot be a more opportune time to have a 360-degree overview of financial sector regulations as we move forward to meet the investment needs of Amrit Kaal. Regulations serve as the foundation for maintaining financial stability, and a well-structured regulatory framework mitigates systemic risks, safeguards consumer interest, and upholds market integrity. A good progress has been made on this front, as the Honorable Finance Minister in the Budget 23-24 proposed to make public consultation and timely review of regulations to simplify, ease, and reduce the cost of compliance as a definitive part of the regulatory life cycle. We need to ensure that regulations are efficient, cost-effective, and responsive to stakeholders. It is vital to have regulations which are simple, easy to understand, and easy to comply with without imposing hardship and uncertainties on regulated entities or creating unintended distortions. Therefore, it is important to have a well-defined, well-designed ex-ante and ex-post cost-benefit analysis framework for regulations to ensure that to evaluate their net impact on financial sector and the economy. In parallel, regulation making may also provide for the feasibility of non-regulatory alternatives to achieve intended outcomes, keeping the principle of proportionality in view. This requires developing a comprehensive regulatory impact assessment framework, which was also echoed in the Economic Survey 2024-25. Moving on to the topic of the high-level committee on regulatory reforms, which the budget speech mentioned. For a more responsive and future-ready regulatory framework, regulations must evolve with changing economic conditions, technological advancements, and global best practices. A good regulatory system does not overburden businesses, especially small and medium ones whose bandwidth is very limited, but ensure stability, transparency, efficiency, and more importantly, consistency. Defining reforms as the fuel to the engine of growth, the Union Budget 25-26 set the stage for deregulation with the powerful objective to scale back the state's role in governance and unleash the full potential, particularly of small and medium enterprises, giving them the freedom to thrive with greater autonomy and create more jobs, which is the most important goal of any economic growth and policy making as well. The budget reaffirmed the government's commitment to trust first and scrutinize later. While significant compliance requirements have been eliminated, the current focus is on modernizing outdated regulations, further improving the ease of doing business through initiatives like Jan Vishwas 2.0 and the constitution of the High-Level Committee on Regulatory Reforms. Through deregulation, MSMEs can indeed better withstand economic shocks, attract long-term investments, grow in size, and drive sustainable growth. The center has been taking conscious and committed steps towards deregulation through continued process and governance reforms. Recent reforms have included a comprehensive revision of income tax laws, streamlining labor regulations, and decriminalizing specific business laws. We look forward to your thoughts and ideas on the scope of the proposed Committee on Regulatory Reforms in the non-financial sector. In conclusion, the reforms we discussed today are not just policy measures, they are enablers of growth, investment, and financial empowerment. Financial inclusion, investment climate, and regulatory efficiency are interconnected. I urge everyone to be solution-driven in today's discussions. I reiterate the urgency, the immediacy, and the importance of these policy announcements becoming policy decisions and implemented quickly enough, given how rapidly the world is changing and evolving, becoming more uncertain in the process. Therefore, I look forward to your valuable inputs with respect to investment, regulatory, and ease of doing business reforms. While concluding this aspect of the webinar on theme 7, I now turn to the other important announcement, which is about the access to credit from the angle of Prevention of Money Laundering Act in the context of KYC simplification. And therefore, on behalf of Secretary Ajay Seth, who is also the current acting Revenue Secretary, I would like to share the government's perspectives on this issue of simplifying KYC. So I move on from the regulatory reform dimension of my initial remarks to this KYC dimensions from the perspective of revenue. In the 23-24 budget, the Government of India announced a commitment to simplifying the KYC process through a risk-based approach. The relevant budget announcement was, and I quote, "The KYC process will be simplified, adopting a risk-based instead of a one-size-fits-all approach. Financial sector regulators will also be encouraged to have a KYC system fully amenable to meet the needs of digital India," unquote. Further, in the budget 25-26 presented on February 1st, further announcements were made with regard to KYC simplification. The relevant language is, I quote, "To implement the earlier announcement on simplifying the KYC process, the revamped central KYC registry will be rolled out in 2025. We will also implement a streamlined system for periodic updating," unquote. A simplified KYC framework is built on three essential pillars: interoperability of KYC records, ensuring that once KYC is completed with one regulated entity, it doesn't have to be repeated for every new service unless required under specific circumstances. Harmonization of regulatory requirements, aligning KYC norms across financial institutions to remove redundancy and inconsistency. 3. Risk-based gradation of customer due diligence, allowing simplified KYC for lower risk customers and a proportionate approach to verification. These are the three pillars of a simplified KYC framework. The effective operationalization of a central repository is an essential element for implementation of any such framework. The Department of Revenue, through amendments to the Prevention of Money Laundering rules, has undertaken key measures already to leverage the central KYC records registry as a single source of truth for KYC verification, thus already enabling a simplified KYC framework. While these measures are transformative, ensuring that financial institutions rely on a centralized and updated KYC record for onboarding and monitoring customers, the amendments notified through GSR 419E dated 19 July 2024 has further improved the operational framework and dependability of the central KYC reports as a single source of truth. CKYCR as a single source of truth. The key reforms that Revenue has already undertaken are mandatory utilization of CKYCRR. Financial institutions are now required to retrieve and use KYC records from CKYCRR before onboarding customers. This eliminates duplication and reduces the burden of repeated KYC submissions for both individuals and businesses. Time-bound KYC updates. All KYC modifications must be updated in CKYCRR within 7 days. Earlier, the reporting entities were not updating the records of the customers on CKYCRR. This amendment, it becomes mandatory for reporting entities to update the records on CKYCRR in a time-bound manner. Third, synchronization across reporting entities. When an update is made in CKYCRR, all institutions linked to the customers must download and update their records. This step eliminates inconsistencies, ensuring a single verified KYC record across multiple financial relationships. 4, regulatory standardization. The regulators have been mandated to issue guidelines to ensure implementation of retrieval, utilization, and updating of the KYC records downloaded from the CKYCR. These reforms have brought multiple benefits such as eliminating duplication, faster consumer onboarding, enhanced AML CFT, anti-money laundering and terrorism financing compliance, ease of doing business as well. From the perspective of financial inclusion, these changes are indeed transformative. A seamless and efficient KYC process ensures that even individuals in remote areas with limited formal documentation can establish their financial identity and gain access to banking, credit, and other financial services. By making KYC simpler, doors are being opened for greater participation in the formal economy, especially for small businesses and underserved communities. Going forward, regulators will continue refining the framework to ensure effective utilization of CKYCR, enabling financial institutions to leverage this repository while maintaining effective and proportionate due diligence regime. These reforms will not only simplify compliance, but also strengthen the financial system by balancing ease of business with robust AML CFT measures and facilitating the onward transition to a risk-based approach to KYC. With that, I hand over the proceedings to Secretary Post, who will talk about access to financial services in the context of the expanding services of the India Post Payments Bank. Thank you very much.
Thank you. Thank you, Dr. Nageshwar. Now we request Secretary Post to make her presentation. Yeah, a PPT also will be sharing. Can you hear us? We can't hear you. Yeah. Now we can hear you. Yeah.
You can? Thank you. So, good morning, everybody. And I'll be quick. Can we start the presentation?
Yes, please go ahead.
Yes. So, our topic of India Post Payments Bank, first I'll just set the context. Can we go to the first slide? This is the context, is the budget speech para number 96 about deepening and expansion of the India Post Payments Bank in rural areas. Next, please. The India Post Payments Bank was started with the RBI's mandate to have facilities for payment and financial services for small businesses, migrant labor, and such low-income groups. And the focus was on low value and high volume transactions. And that focus has been there through in the bank. The RBI's payment bank guidelines, the national objectives for financial inclusion, and the use of Aadhaar for DBTs under the national objectives and the self-sustaining objectives, that this has to be a sustainable business model and a digital-first approach. These have been achieved by this bank. The IPPB was inaugurated only in September 2018 by the Honorable Prime Minister. It is 100% equity owned by the Government of India, and it is a fully paperless digital bank.
Similar thing.
Next, please. Next, please. Now, the landscape in which it is operating, the approach was to leverage the post office network, where in the villages, particularly since we are focusing on the village rural areas, we have Gramin Dak Sevaks. So most of the people who are working for them are the Gramin Dak Sevaks. So there are 1.65 lakh locations where 5.85 lakh villages are covered. So, and that is within 5 kilometers, almost all villages except some leftover villages that are also being covered. Now, out of that, those banking access points, against that, there are 11 crore savings accounts already, and the pace of pickup of this easy opening of accounts is very high. There are up to 70 to 80,000 accounts being opened every day. Now the people are very comfortable with it. The account opening takes barely 5 minutes, even less, and it is based on the Aadhaar. It is extremely simple, and as soon as the account is opened, you can start using it. There is no lag period. So 44% of the users are women. The transactions in UPI, there have been already more than 1,000 crore transactions. And interestingly, there is a figure which came up that since India is the largest, largest number of digital transactions, alone IPPB has 3% of the world's transactions. So that is an amazing thing. So the points of access and usage have been fully fulfilled except for the credit part. So the rest of it is there. And the quality is also there, because when you look at the devices, these are simple smartphone devices, work very well, and API integration is very clean. So these three aspects in terms of access, in terms of financial inclusion, that is access, usage and quality, are met, but credit is not available through these banks, except if there is some very small microcredit, it could perhaps still flow to an individual, because there is an upper limit of 2 lakhs in the accounts. Now, the insurance piece is doing well. It is actually growing now, and there is a high focus on general insurance products. This is all through tie-ups, because IPPB is a corporate BC. So in a way, it kind of nicely synchronizes with what Post is also doing on a not a very large scale, but micro or a small level of life insurance is done by Post directly. So there is a good synchronization of the kind of work being done. And there is a familiarity at the rural level on how to sell insurance products. So smaller ticket products, easier products, but general insurance also is interestingly selling well, which includes health products and accident insurance products and some slightly bundled products, and also motor vehicle insurance is doing very well in the rural areas. DBT is a big piece. Now already about 8% of the DBT is being done by India Post Payments Bank. And out of the PM Kisan payments for DBT, 12% was done by the India Post Payments Bank. Overall, with India Post Payments Bank and the Post Office Savings Bank, the DBT is about 10%. So citizen-centric services, a very wide range of services are there. The key ones being the child enrollment light clients, that is basically children are enrolled on Aadhaar through using their parents' Aadhaar numbers. And there is mobile number updation in Aadhaar, which is available through IPPB on the device, and digital life certificates at the doorstep, with a new initiative last year done with face recognition technology, and it has worked very well for older people, because as you know, the biometric doesn't work that well, and iris is very difficult, it's expensive, difficult to carry around. So this is doing very well, and the movement to facial recognition is something which we need to look at across. Aadhaar-enabled payment systems, particularly in COVID, there was a big spike because these services were given for other bank withdrawals up to rupees 10,000 and also deposits available. This is also doing well, but it could pick up more. So next slide, please. Now, when we look at where we can expand, we see the present tie-ups. Just take a look at the tie-ups. There is a list of various ministries, all kinds of DBTs. Then there are these states also, Mukhyamantri, Mazi, Ladki Behan. So Madhya Pradesh, Maharashtra, Subhadra Yojana in Odisha, and many other state schemes. There are tie-ups which are done by the field officers there. The Chief Postmaster General do those. Now, on the private partnerships, this is the list just to show, and there are loan referrals also happening. But loan referrals is a relatively slower business because these are physical referrals. Here, I don't think the loan portal is being used here. So, other than that, the key role of India Post Payments Bank and which it has achieved is financial inclusion, the literacy piece through the camps, and not just the financial literacy but digital literacy. The interesting thing is that the adoption of digital modes of payments has been amazing in rural areas, and this has set the path for now the next step, which is the credit. And this Niveshak Didi is part of this other schemes which are being done by states. Dark Chopals, these are Chopals which are actually faces in the villages. In the last 1.5 years, the Department of Posts has organized nearly 50,000 of these dark Chopals, and about 50 lakh people participated, including nearly half women. And in this, the cooperation, the coordination with India Post Payments Bank, with other entities like NABARD and the RBI entity, I'm sorry, I forget the name always. So their funds are also coming in the small funds, but it helps in the camps. And we try to also integrate with the state government's other camps wherever possible, say a health camp is being held. So this is the inclusion piece, which is very critical, we feel, the extension to the people. So this is being done. Next. Now, the future expansion plan, one is on the same lines, and I will put a pension piece here also, seeing what the Chief Economic Advisor said specifically, and also what the Department of Financial Services said. We also have to have a pension piece. Then we need to definitely move into credit, actual credit disbursal. But the only way to go ahead with that for India Post Payments Bank is to go into becoming an India Post Small Finance Bank. Now, proposals for this have been looked at by RBI earlier, and they would have their way of looking at it. Considering there are about 11 small finance banks already out there existing, and there are a total of 6 payments banks, out of which 3 are really active, including the India Post Payments Bank. So how to manage that space is really beyond my pale. I don't think I should comment on that. But definitely, if we look at the objectives of small finance banks, which talk about in the RBI's mandate, savings in underserved and unserved areas, then supply of credit to small business units, marginal farmers, MSCs, etc., and the focus on priority sector lending with 75% being there. Also, the other pieces, that is that you need to have a certain structure of the bank. Other pieces are fitting very well because this is a digital paperless bank. Actually, more than 70% of the branches are in rural areas. For SFBs, the norm is 25% plus. So the rest of it is met very well. Now the issue is mainly for the regulator, for the DEA and for DFS to take a look. The India Post is ready, poised, waiting for such a decision. The question is, there is a timeline there, and definitely regulatory approvals with the actual setting up of the bank. There will be a totally new set of people coming in. There will be a small capital infusion. It says 200 crores, I think I saw the minimum equity, but that depends on what the size we are looking at. So those things do take time. The interim measures which could be suggested, it is for government to take a call, are 2, and that is related to the Post Office Savings Bank. The Post Office Savings Bank is linked with the India Post Payments Bank as its banker in a way. The sweep in and sweep out facility, which is necessary for every payments bank to have with another scheduled commercial bank. In the case of IPPB has been allowed with the post office savings bank because there is no limit in those accounts. But the problem is that these are just savings accounts. Now, if we are evolving very fast into an India Post Payments Bank, small finance bank, that's fine. But if it is going to be slow and there is a need to go slow, seeing the other players in the landscape, there would be an intermediate path which could be possible, which is institutional savings accounts and also term deposit accounts for institutions. And the institutions could be ring-fenced. It could perhaps be unincorporated entities, which is primarily focusing on SHGs and small players, which are micro enterprises. So that is what we have felt after a lot of discussion, and there was a lot of discussion in the theme 1. So we feel that the time is right for India Post Payments Bank to turn into a small finance bank, but it is for the regulators and other players to take a call. I think I should stop here. Thank you.
Thank you. Thank you, madam. Can we now request Secretary MCA? Madam Secretary
Good afternoon,
MCA?
everybody.
Yeah.
Yes, good afternoon, everybody. In the interest of time, I will move straight to what the subject is about. So the sub-theme of our presentation is essentially about how we can make India more investment friendly, and we're looking at a very specific aspect of the merger of companies. So the budget announcements next. The budget announcement, para number 101, said that if you read it out, it says requirements and procedures for speedy approval of company mergers will be rationalized, and the scope for fast-track mergers will also be widened and the process made simpler. We all know, all the stakeholders here, that before the Companies Act came into existence, under the old Companies Act, the entire process used to be driven by the High Court. After that, now we have 2 specific tracks under which mergers and acquisitions are dealt with. The first through the NCLT, and the other is through the fast-track mergers through the regional director. In fast-track mergers, essentially we look at small companies or companies which are a wholly owned subsidiary company merging with the main company. Next. We have made certain reforms ever since 2013 Act also came into place. Firstly, the appointed date concept, where the merger or the scheme had to come into existence, used to be a very inflexible date in a calendar date. Now it has become linked to a future event, which is giving much more flexibility to the parties concerned to choose from where this merger or acquisition can come into force. Then, like we have mentioned in the budget announcement, we have done some expansion in the scope of the fast-track mergers, allowing startups to be merged by the regional director, which this process is supposed to take only 60 days. It, of course, goes into long time for various reasons, which we will be looking at when we look at the suggestions which we have under consideration. And another important aspect which has just been done in September 2024, where we allow reverse flipping. That is, a foreign company can merge with a wholly owned subsidiary in India. This is really good. It was a demand from the IT industry which has been accepted. Coming to what are the suggestions on the board which we are looking at in terms of the merger and acquisition space. The first is now under the NCLT, when we have 2 companies who are looking for a merger, both the NCLTs have to go through the entire process of convening the meetings, getting permissions from the respective regulators, and passing the twin test approval, the threshold for that. There has been suggestions that we may allow one bench at the NCLT to look at the merger application. So this is on the table again for discussions forward. Then we look at how we can expand the scope of companies which use the regional director route. And here the suggestions received are basically to look at, the unlisted companies, or even some public companies who can come with who have a certain amount of credit outstanding only to come under this track. Like I had mentioned earlier, for the merger acquisition scheme to get passed, it needs to pass the twin threshold test in terms of the NCLT, which is a fairly more relaxed relaxed provision compared to that for the fast track mergers, where it is actually the threshold is 90% of the total shareholding, whereas in the NCLT routes it's about it's a majority of numbers and 75% of the present and voting, forming the 75% of the shareholding. So this is the same test is applicable for creditors also. So we're looking at a similar kind of a threshold for fast track mergers. How do we save the interests and the guardrails, like we say? How do we save the interests of the shareholders and creditors? There's already a provision under the fast track mergers where the regional director can make a reference to the NCLT. Is that sufficient, or do we need to go down some other, look at some more guardrails to help and safeguard their interests? Are basically the 3 or 4 the broad areas and where we have received suggestions, and we are looking forward to a very constructive and fruitful and two-way interaction during the parallel session, so that we can not only thrash out these issues but any other nitty-gritty issues which come down to implementation, both at the NCLT level in terms of their rules which they are following, as well as the fast track mergers which are done by the regional directors. Thank you very much.
Thank you. May I request DPIT AS?
Good afternoon, everyone. The secretary is in another theme session, so I'll be presenting on his behalf. To continue with what CES sir said on decriminalization and ease of doing business, and on the budget announcement for Jan Vishwas 2. If we look at the India story, we started with the ease of doing business journey almost a decade ago, and it has reflected in our steady climb over the doing business report from 142 in 2011 to 63 in 2019. Over the period of time, we have reduced the compliance burden, ensuring a vision of implementing the minimum government, maximum governance. And we've touched on ease of doing business as well as ease of living. Next slide, please. The approach has been 4-pronged: simplification, elimination, digitization, and decriminalization, which is what I'm going to touch on today. For this, we launched a regulatory compliance portal in which states as well as central ministries have been indicating their provisions which need to be decriminalized, and then subsequent action has been taken. Over a period of time since 2020, even before the Jan Vishwas Act of 2023 came into being, 283 provisions across 38 acts and 13 ministries and departments have been decriminalized. Extensive review has been taken across various ministries, and there are various acts which are under decriminalization or under review, as well as the Jan Vishwas 2 Act. Now, the thrust of the entire exercise for decriminalization has been a transition towards a trust-based governance, where the ultimate beneficiary would be the citizen and the businesses, so that for minor infractions, procedural, technical defaults, where there is no malafide, citizens are not imposed criminal sanctions. Next slide. If we look at the Jan Vishwas Act journey of 2023, it was one of the first consolidated acts, saving time of the legislature itself, as well as reducing burdens on the judicial system. Some of the illustrative examples, if we see, are on the Environmental Protection Acts, where we've looked at provisions which were all encompassing in nature. So they've been graded. Pasturing cattle, where it has been replaced with a penalty, and imprisonments have been replaced with fines or with penalties. Next. For the Jan Vishwas 2, we've worked very closely with the industry associations, with various stakeholders, as well as ministries, have held numerous interministerial committee meetings, and have also started working with the state level decriminalization, because many of the state acts are unable to decriminalize their provision because of overriding influence of the central acts, which is also being taken up for the Jan Vishwas 2, as well as self-identification by various ministries. So we are moving now from the central level, apart from Jan Vishwas 2, which we are hoping to place shortly to the Parliament, to a focus shifting towards states for a consolidated decriminalization act. We have good examples in states like Tamil Nadu, which have taken up consolidated decriminalization measures across their various municipal acts, as well as states like Gujarat. We also have Madhya Pradesh, which has come up with the consolidated act of Jan Vishwas state, one of the first consolidated acts which has just come up recently. And states like Haryana, which are also progressing very fast on decriminalization. We've touched almost 1,300 provisions and reviewed them at various levels. Next. So this is the suggested methodology which we have followed, and we request the other stakeholders as well as states as well as ministries to also take up a review of these acts, because many of these acts have not been reviewed over time. So to identify the actionable reform area, essentially keeping in mind the vision of a trust-based governance, grade the offences. Many of the provisions are large, and they are general provisions which say that any infraction of any provision of the act will have a provision of a criminal, attract a criminal sanction. Then we have had numerous stakeholder consultations with the departments, the ministries, as well as with the states and the industry stakeholders. And then a consolidated amendment is being proposed. Next. So this is the suggested methodology, how we've done it. We've graded the offences across levels of severity, 5 being the one where we also don't recommend decriminalizing that offense, because obviously it has malafide provisions in it and cannot be decriminalized. So essentially we are looking at small infractions which could be decriminalized. So 1, 2 and 3 mostly, where for the first and the second levels of severity, we recommend omission and repealing of the entire provision itself. For 3 and 4, largely we look at the imprisonment either being converted into a fine or into a penalty. And the penalty can also be based on the subject matter instead of a fixed monetary amount. The other one is where there are provisions of compounding, but they've not been delegated till now. We have requested stakeholders to ensure, the stakeholder ministries to ensure that compounding provisions are also built. Having said all this, we are now on a fast track to lay the Jan Vishwas 2 bill for consideration of the Parliament. Thank you so much.
Thank you. Thank you, Madam. Now may I request Niti Aayog, Senior Advisor.
Thank you so much. I would just like to share the screen. Thank you so much. So this topic is on investment friendliness index of states. As India charts its path to becoming a $30 trillion economy by 2047, unlocking the investment potential of states will be a defining factor. And this initiative, Investment Friendliness Index for States, aims to create a dynamic, transparent, and globally competitive business environment, ensuring that India remains a premier destination for investors worldwide. In July 2024, while chairing the 9th Governing Council meeting of Niti Aayog, Honorable Prime Minister had directed that we need to develop an investor-friendly charter and index which ranks states on their ability to attract investments. The latest budget announcement reinforces the government's commitment to making India a more investment-friendly, and above all, it recognizes that stronger states drive a stronger nation. And a key step in this direction is the launch of the Investment Friendliness Index of States in 2025, which fosters competitive and cooperative federalism and also encourages states to enhance their regulatory frameworks to attract investments. India has emerged as a global investment destination, with the states playing a pivotal role in shaping the investment landscape through policy innovation, infrastructure development, and targeted incentives. While some states have long established industrial ecosystems, others are rapidly enhancing their regulatory frameworks. improving their business efficiency and reducing sector-specific policies to attract investors. And this current slide is showing you that in recent years, India has significantly scaled up infrastructure investment, strongly emphasizing physical, digital, and social infrastructure. In fact, the union government's capital expenditure, the CapEx, on significant infrastructure sectors has grown at a trend of 38.8% from FY20 to FY 2024, which reflects a clear and long-term commitment to development of infrastructure in particular and development of the nation as a whole. Now, this slide, I will not dwell on it too much because the time is very scarce, but this major initiatives such as the National Infrastructure Pipeline, National Monetization Pipeline, PM Gati Shakti Framework, the massive expansion in railways, the Bharatmala Pariyojana, the expansion on the airports, the new terminal building of airports, renewable energy capacity which are being developed at a very high pace. In fact, they have grown 15.8% year on year and have reached 209.4 gigawatts in December 2024. Similarly, the Jal Jeevan Mission, the Swachh Bharat Mission Urban and Smart City missions are some of the many initiatives of the central government. Now, in fact, I would like to dwell a little bit more on this part. Now, even with this, there are many issues and challenges which continue to stand in the way. And these include the limited private sector participation. In fact, this is where the deliberations of today will be very, very useful. We would in fact encourage the webinar participants to dwell and to offer their solutions or suggestions in this regard. Similarly, so the first important point is the limited private sector participation, where the private investment remains low despite the fact that the public capital expenditure has grown by 38.8% over the past 5 years. Even initiatives like National Monetization Pipeline and PPPs, this has still led to uneven state policies which create regional disparities in infrastructure growth. Similarly, regulatory bottlenecks in terms of land acquisition delays, state level governance inefficiencies, and other environmental regulations also are retarding development here. The uneven capex utilization, which we are seeing in various states, is also resulting in a lot of uneven development across the regions. I would like to dwell a bit on labor and skilling gaps. Now, the low labor force participation rate, the LFPR, especially among women, and statewide skill mismatches has hindered the workforce readiness in various states. While Vishwakarma and skilling programs have offer a great potential, and industry alignment remains a big challenge. Similarly, infrastructure gaps in smaller cities, especially if you take tier 2 and tier 3 cities, which lack reliable broadband, logistics, and power supplies. These are adversely affecting large-scale investments being drawn to these places. Uneven progress in transport expansion and frequent power shortages are all big obstacles in the face of which are hindering the development. Similarly, state-wise policy differences, investment policies, taxation structures, incentive programs which vary across states, this make it very difficult for businesses to predict long-term returns and which impact the EODB rankings of not just the state but the nation as a whole. If you look at urban infrastructure and housing, this has created a huge pressure, and a rapid urbanization is going to lead to greater amount of strains on our infrastructure. And this is specially called for in where industrial hubs are located. Similarly, inconsistency in the green infrastructure adoption across states, especially the coastal areas or even other such areas, these tend to show that there's a lack of uniform green policy adoption across the states, and this has impacted the sustainable industrialization across the regions. Now, therefore, I would urge that today's webinar really dwell on the various strategies which can be really brought to the fore to operationalize this announcement of the budget, where the states continue to play their role in developing their specific regions. They're coming up with their unique abilities to be able to address the challenges which occur. And I would like to just leave this last slide, which is that some of the issues for discussion for actually operationalizing this index. So what are the pillars we need to identify? Should there be a composite index, or should we have states should be categorized in different geographical characteristics like coastal, landlocked? Similarly, should there be a sectoral index? What should be the methodology to collect the primary data? Similarly, what should be the frequency of the index? I mean, how often do we need to update this index? Niti Aayog has already commenced work on this, and therefore inputs from this webinar would go a long way in helping us finalize this index at the earliest. Thank you so much.
Thank you very much. Now we will all wait for the Honorable Prime Minister and the ministers, respective ministers, to join. So we are waiting here, I think.
Yeah, but not to
yeah,
log off, sir.
Yeah, I think all of us should keep the videos on and not log off. I request especially those of you who have joined from outside Delhi and the CEOs, other sector specialists, other stakeholders, kindly remain logged and video on. Thank you.
This meeting is no longer being recorded.
संजय जी आवाज आ रही है?
अब जारी होगी, ऑन हो गया। आ रही है, यस आवाज आ रही है।
सर मेरी रिक्वेस्ट है, आप जितने भी ये वेबिनार में लोग जुड़े हैं उनको रिक्वेस्ट कर लीजिए कैमरा ऑन करने, क्योंकि अब हम पीएमओ को मर्ज कर रहे हैं सर। आप देखिए आपके
रैशनलाइजेशन ऑफ
बिल्कुल अभी कह रहे हैं हम।
थैंक यू सर इसको मर्ज करो।
अशोक जी एडिशनल सेक्रेटरी साहब बैठे हुए हैं।
नहीं कोई बात नहीं, डोंट वरी। आज ये नीचे कर लीजिए, ये सब दोनों नीचे कर लीजिए। आई विल रिक्वेस्ट सेमिनार में कनेक्टेड, आई विल रिक्वेस्ट ऑल द सेमिनार वेबिनार पार्टिसिपेंट्स टू कीप देयर वीडियो ऑन प्लीज एंड माइक्स ऑन म्यूट, because this will be reflected in the before the Honorable Prime Minister. So I'll request everyone to keep their video on and mics on mute, please. All webinar participants
it is once again requested that the video should be kept on and the mic be kept on mute, because we will be visible before the Honorable PM.
नहीं 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 ऑफ करा दो कैमरे में फिर ऊंचाई में दिखाएगा
नहीं कैमरा ऑन करने से रहेंगे ना अपनी सीट पे बैठे विकास के सर को बंद कर क्योंकि दे हैव मल्टीपल फ्रेम्स कैमरा ऑन किसका दे हैव प्लेंटी ऑफ फ्रेम्स टू आई वांट टू गिव सम स्पेस
ये पार्टी
I'll just hold it, please hold it. That used to be in the RTC buses. Hello.
Manish Bharadwaj.
May I request Mr. Manish Bharadwaj, UIDAI, to keep the video on, please?
Manish is a CEO, no? Partial CEO.
Yep.
Once again, request all those whose videos are off to kindly turn on the video. The active participant list. Let there not be any confusion. We are not talking about the passive links. The active participant links who are all on video off, please kindly turn on the video. Thank you.
This meeting is being recorded.
अमित सर,
हाँ जी सर। सर
जो MSME है ना,
हाँ
उनके भी फ्लैग प्रॉपर नहीं है। यदि आप इतने बड़े में दिखा रहे हो तो फिर उनका फ्लैग सही करवा लो।
लेआउट की कमांड नहीं रहता।
जो आप लोग
MSME कौन है?
से joined है ना, तो उनको
MSME भी दिखा दो एक बार, फिर सही करवा लो। थोड़ा साइडों में पुश करवा दो प्लीज।
Let me see if let me find out. Let me find out then in that case. Yeah. So Nitin,
माननीय प्रधानमंत्री जी नमस्कार। मैं इस पोस्ट बजट वेबिनार में आपका हार्दिक स्वागत करता हूं। आज इस वेबिनार में 3 विषयों पर स्टेक होल्डर के साथ विचार विमर्श तथा मंथन होगा। एक है MSMEs as an engine of growth. Secondly, manufacturing, exports and nuclear energy missions. And thirdly, regulatory investment and ease of doing business reforms. मैं माननीय प्रधानमंत्री जी का आभार व्यक्त करता हूं कि आपने अपने बिजी शेड्यूल के बावजूद इस वेबिनार को समय दिया। अब मैं आपसे निवेदन करता हूं कि कृपया हमारा मार्गदर्शन करें। धन्यवाद।
नमस्कार। कैबिनेट के मेरे सभी साथियों, फाइनेंस और इकोनॉमिक एक्सपर्ट्स, स्टेक होल्डर्स, देवी और सज्जनों, मैन्युफैक्चरिंग और एक्सपोर्ट पर यह बजट वेबिनार हर दृष्टि से बहुत ही महत्वपूर्ण है। आप जानते हैं, यह बजट हमारी सरकार के तीसरे कार्यकाल का पहला पूर्ण बजट था। इस बजट की सबसे खास बात रही अपेक्षाओं से अधिक डिलीवरी। कई सेक्टर्स ऐसे हैं जहां एक्सपर्ट्स ने भी जितनी अपेक्षाएं की थी उससे बड़े कदम सरकार ने उठाए और आपने बजट में देखा है। मैन्युफैक्चरिंग और एक्सपोर्ट को लेकर भी बजट में महत्वपूर्ण फैसले किए गए हैं। साथियों, आज देश एक दशक से भी ज्यादा समय से सरकार की नीतियों में इतनी कंसिस्टेंसी देख रहा है। बीते 10 वर्षों में भारत ने लगातार रिफॉर्म्स, फाइनेंशियल डिसिप्लिन, ट्रांसपेरेंसी और इंक्लूसिव ग्रोथ को लेकर अपनी प्रतिबद्धता दिखाई है। कंसिस्टेंसी और रिफॉर्म्स का एश्योरेंस एक ऐसा बदलाव है जिसकी वजह से हमारी इंडस्ट्री के भीतर नया आत्मविश्वास आया है। मैं मैन्युफैक्चरिंग और एक्सपोर्ट से जुड़े प्रत्येक स्टेक होल्डर को ये विश्वास दिलाता हूं कि ये निरंतरता आने वाले वर्षों में ऐसी ही बनी रहेगी। आप मेरे पूरे विश्वास के साथ मैं आपसे आग्रह करता हूं, पूरे आत्मविश्वास से निकल पड़िए, बड़े कदम उठाइए। देश के लिए मैन्युफैक्चरिंग और एक्सपोर्ट ये नए एवेन्यूज हमने ओपन करने चाहिए। आज दुनिया का हर देश भारत के साथ अपनी इकोनॉमिक पार्टनरशिप को मजबूत करना चाहता है। हमारे मैन्युफैक्चरिंग सेक्टर्स को इस पार्टनरशिप का ज्यादा से ज्यादा लाभ उठाने के लिए आगे आना चाहिए। साथियों, किसी भी देश में विकास के लिए स्टेबल पॉलिसी और बेहतर बिजनेस एनवायरनमेंट बहुत जरूरी है। इसलिए कुछ वर्ष पहले हम जन विश्वास एक्ट लेकर आए। हमने कंप्लायंसेस को कम करने का प्रयास किया। केंद्र और राज्य स्तर पर 40,000 से ज्यादा कंप्लायंसेस खत्म किए गए। इससे ईज ऑफ डूइंग बिजनेस को बढ़ावा मिला और हमारी सरकार ये मानती है कि एक्सरसाइज निरंतर चलती रहनी चाहिए। इसलिए हम सिंप्लीफाइड इनकम टैक्स की व्यवस्था लेकर आए। हम जन विश्वास 2.0 बिल पर काम कर रहे हैं। नॉन फाइनेंशियल सेक्टर के रेगुलेशंस को रिव्यू करने के लिए एक कमेटी का गठन का भी निर्णय हुआ है। हमारा प्रयास है कि इन्हें मॉडर्न, फ्लेक्सिबल, पीपल फ्रेंडली और ट्रस्ट बेस्ड बनाया जा सके। इस एक्सरसाइज में इंडस्ट्री की बहुत बड़ी भूमिका है। आप अपने अनुभवों से उन समस्याओं की पहचान कर सकते हैं जिनके समाधान में ज्यादा समय लगता है। आप प्रोसेसेस को और ज्यादा सरल बनाने के सुझाव दे सकते हैं। आप गाइड कर सकते हैं कि कहां पर टेक्नोलॉजी का उपयोग करके हम जल्दी और बेहतर परिणाम हासिल कर सकते हैं। साथियों, आज दुनिया राजनीतिक अनिश्चितता के दौर से गुजर रही है। पूरी दुनिया भारत को एक ग्रोथ सेंटर के तौर पर देख रही है। कोविड संकट के दौरान जब ग्लोबल इकोनॉमी में मंदी आई, तब भारत ने ग्लोबल ग्रोथ को रफ्तार दी। ये ऐसे ही नहीं हो गया। हमने आत्मनिर्भर भारत के विजन को आगे बढ़ाया और रिफॉर्म्स की अपनी गति को और तेज किया। हमारे प्रयासों से इकोनॉमी पर कोविड का प्रभाव कम हुआ। इससे भारत को तेज गति से बढ़ने वाली अर्थव्यवस्था बनाने में मदद मिली। आज भी भारत ग्लोबल इकोनॉमी के लिए एक ग्रोथ इंजन बना हुआ है। यानी भारत मुश्किल से मुश्किल हालातों में अपने रेजिलियंस को साबित कर चुका है। पिछले कुछ वर्षों में हमने देखा है कि जब सप्लाई चेन डिस्टर्ब होती है तो उसका असर पूरी दुनिया की अर्थव्यवस्था पर पड़ता है। दुनिया को आज ऐसे भरोसेमंद पार्टनर की जरूरत है जहां से हाई क्वालिटी प्रोडक्ट्स निकले और सप्लाई रिलायबल हो। हमारा देश ये करने में सक्षम है। आप सब सामर्थ्यवान हैं। ये हमारे लिए बहुत बड़ा मौका है, बहुत बड़ी अपॉर्चुनिटी है। मैं चाहता हूं विश्व की इन अपेक्षाओं को हमारी इंडस्ट्री एक स्पेक्टेटर की तरह न देखे। हम दर्शक बनकर के नहीं रह सकते हैं। आपको इसमें अपनी भूमिका तलाशनी होगी। अपने लिए अवसरों को आगे बढ़ाकर तराशना होगा। पुराने समय की तुलना में आज ये कहीं आसान है। आज इन अवसरों के लिए देश के पास फ्रेंडली नीतियां हैं। आज सरकार इंडस्ट्री के साथ कंधे से कंधा मिलाकर खड़ी है। एक मजबूत संकल्प, ऑब्जेक्टिविटी के साथ ग्लोबल सप्लाई चेन में अवसर की तलाश, चैलेंज को एक्सेप्ट करना, इस तरह हर इंडस्ट्री एक एक कदम आगे बढ़े तो हम कई मील आगे निकल सकते हैं। साथियों, आज 14 सेक्टर्स को हमारी पीएलआई स्कीम का फायदा मिल रहा है। इस योजना के तहत 750 से ज्यादा यूनिट्स को मंजूरी दी गई है। इससे 1.5 लाख करोड़ रुपए से ज्यादा का इन्वेस्टमेंट आया है। 13 लाख करोड़ रुपए से ज्यादा का प्रोडक्शन हुआ है और 5 लाख करोड़ रुपए से ज्यादा का एक्सपोर्ट हुआ है। ये दिखाता है कि अगर हमारे एंटरप्रेन्योर्स अगर उनको अवसर मिले तो वो हर नए क्षेत्रों में भी आगे बढ़ सकते हैं। मैन्युफैक्चरिंग और एक्सपोर्ट को बढ़ावा देने के लिए हमने 2 मिशन शुरू करने का फैसला किया है। हम बेहतर टेक्नोलॉजी और क्वालिटी प्रोडक्ट्स पर फोकस कर रहे हैं और लागत कम करने के लिए स्किलिंग पर जोर दे रहे हैं। मैं चाहूंगा कि यहां मौजूद सभी स्टेक होल्डर्स ऐसे नए प्रोडक्ट्स की पहचान करें जिनकी वर्ल्ड में डिमांड है, जिनकी मैन्युफैक्चरिंग हम कर सकते हैं। फिर हम उन देशों तक एक स्ट्रेटेजी के साथ आज जाएं जहां एक्सपोर्ट की संभावनाएं हैं। साथियों, भारत की मैन्युफैक्चरिंग यात्रा में R&D का अहम योगदान है। इसे और आगे बढ़ाने और गति देने की आवश्यकता है। R&D के द्वारा हम इनोवेटिव प्रोडक्ट्स पर फोकस कर सकते हैं, साथ ही प्रोडक्ट्स में वैल्यू एडिशन कर सकते हैं। हमारी टॉय, फुटवेयर और लेदर इंडस्ट्री के सामर्थ्य को दुनिया जानती है। हम अपने ट्रेडिशनल क्राफ्ट के साथ मॉडर्न टेक्नोलॉजीज को जोड़कर बड़ी सफलता हासिल कर सकते हैं। इन सेक्टर्स में हम ग्लोबल चैंपियन बन सकते हैं और हमारा एक्सपोर्ट कई गुना बढ़ सकता है। इससे इन लेबर इंटेंस सेक्टर में रोजगार के लाखों अवसर तैयार होंगे और एंटरप्रेन्योरशिप को बढ़ावा मिलेगा। पीएम विश्वकर्मा योजना के द्वारा पारंपरिक हस्तशिल्पियों को एंड टू एंड सपोर्ट मिल रहा है। हमें ऐसे कारीगरों को नए अवसरों से जोड़ने के प्रयास करने होंगे। इन सेक्टर्स में अनेक संभावनाएं छिपी हुई है। उसे विस्तार देने के लिए आप सभी को आगे आना ही चाहिए। साथियों, भारत के मैन्युफैक्चरिंग की, हमारी इंडस्ट्रियल ग्रोथ की बैकबोन हमारा एमएसएमई सेक्टर है। 2020 में हमने एमएसएमई की डेफिनेशन को रिवाइज करने का बड़ा फैसला लिया था। ऐसा 14 साल बाद किया गया। हमारे इस फैसले से एमएसएमई का ये डर खत्म हुआ कि अगर वो आगे बढ़ेंगे तो सरकार से मिलने वाले लाभ बंद हो जाएंगे। आज देश में एमएसएमई की संख्या बढ़कर 6 करोड़ से ज्यादा हो गई है। इससे करोड़ों लोगों को रोजगार के अवसर मिले। इस बजट में हमने एमएसएमई की डेफिनेशन को फिर विस्तार किया है ताकि हमारे एमएसएमई को निरंतर आगे बढ़ते रहने का कॉन्फिडेंस मिले। इससे युवाओं के लिए और ज्यादा रोजगार के अवसर तैयार होंगे। हमारे एमएसएमई के सामने सबसे बड़ी समस्या ये थी कि इन्हें लोन आसानी से नहीं मिलता था। 10 वर्ष पहले एमएसएमई को लगभग 12 लाख करोड़ रुपए का लोन मिला था, जो 2.5 गुना बढ़कर लगभग 30 लाख करोड़ रुपए हो चुका है। इस बजट में एमएसएमई के लोन के लिए गारंटी कवर को 2 गुना करके 20 करोड़ रुपए तक किया गया है। वर्किंग कैपिटल की जरूरतों के लिए 5 लाख रुपए की सीमा वाले कस्टमाइज क्रेडिट कार्ड दिए जाएंगे। साथियों, हमने लोन पाने की सुविधा दी, साथ ही एक नए तरह के लोन की व्यवस्था तैयार की। लोगों को बिना गारंटी लोन मिलने लगा, जिसके बारे में उन्होंने कभी सोचा भी नहीं था। पिछले 10 वर्षों में मुद्रा जैसी बिना गारंटी लोन देने वाली योजनाओं से भी लघु उद्योगों को मदद मिली है। ट्रेड्स पोर्टल के द्वारा लोन से जुड़ी कई समस्याओं का भी समाधान हो रहा है। साथियों, अब हमें क्रेडिट डिलीवरी के लिए नए मोड विकसित करने होंगे। हमारा प्रयास होना चाहिए कि हर एमएसएमई की पहुंच लो कॉस्ट और टाइमली क्रेडिट तक हो सके। महिला, एससी और एसटी समुदाय के 5 लाख फर्स्ट टाइम एंटरप्रेन्योर्स को 2 करोड़ रुपए को उसका लोन दिया जाएगा। फर्स्ट टाइम एंटरप्रेन्योर्स को सिर्फ क्रेडिट सपोर्ट ही नहीं चाहिए, बल्कि उसे गाइडेंस की भी जरूरत होती है। मैं समझता हूं इंडस्ट्री को ऐसे लोगों की मदद करने के लिए एक मेंटरशिप प्रोग्राम बनाना चाहिए। साथियों, निवेश को बढ़ाने के लिए राज्यों की भूमिका बहुत अहम है। इस वेबिनार में राज्य सरकारों के अधिकारी भी मौजूद है। राज्य ईज ऑफ डूइंग बिजनेस का जितना बढ़ावा देंगे, उतनी ज्यादा संख्या में निवेशक उनके पास आएंगे। इसका सबसे ज्यादा फायदा आपके ही राज्य को होगा। राज्यों के बीच ये कंपटीशन होना चाहिए, कौन इस बजट का ज्यादा से ज्यादा फायदा उठा पाता है। जो राज्य प्रोग्रेसिव पॉलिसीज के साथ आगे आएंगे, कंपनियां उनके यहां निवेश करने पहुंचेगी। साथियों, मुझे विश्वास है कि आप सभी इन विषयों पर गंभीरता से विचार कर रहे होंगे। इस वेबिनार से हमें एक्शनेबल सॉल्यूशंस तय करने हैं। पॉलिसी, स्कीम और गाइडलाइन तैयार करने में आपका सहयोग महत्वपूर्ण है। इससे बजट के बाद इंप्लीमेंटेशन स्ट्रेटेजीज बनाने में मदद मिलेगी। मुझे विश्वास है कि आपका योगदान बहुत उपयोगी सिद्ध होगा। आज दिन भर की चर्चा से जिस मंथन से अमृत निकलेगा, वो जिन सपनों को लेकर के हम जा रहे हैं, उन सपनों को पूरा करने का सामर्थ्य देगा। इसी अपेक्षा के साथ आप सबका बहुत बहुत धन्यवाद।
This meeting is no longer being recorded.
I think since automatically everybody will get into their own web portals. I think we can start at 1:15.
This meeting is being recorded.
And on team 7. on Team 7. Thank you. Thank you.
This meeting is no longer being recorded.
Hi, good afternoon. Can someone from DFS confirm that I'm on the right panel? Manoj ji,
Yes, you're on the right panel.
Yeah, okay, great.
Okay.
I'm not able to put up my one pager. So
Yeah. Let me just check. We'll try
Okay.
to enable that. Let me just have a.
Okay. Okay, great. Thank you.
We'll start in about 4-5 minutes time. 1:15.
Yeah. Okay, sir. Okay.
Yeah, good afternoon. I request the panelists to have a check now. The video sharing has been enabled. Sorry, the screen sharing has been enabled. Yeah, so we can unshare it. I think we have a check, which I think.
But it's not clear. Content, yeah. This is visible. Good.
I can see we have a test check which has happened. I can see Madam Vibha, I can see your screen shared here. So I think now we can start on a formal way. So if we can pull out this and share the screen now, please. Yeah, Rajkiranji, we can see that, so you can unshare it.
Yeah.
Thank you. Thank you. So good afternoon again to everyone. So welcome back to the webinar on regulatory investment and ease of doing business reforms. So Honorable Prime Minister has given us a guidance through his kind participation and sharing his valuable inputs and thoughts. So taking this forward, let's start the breakout session on making India investment friendly. So we will, in this session, we shall deliberate on the following budget announcements. One is on FDI on insurance sector, credit enhancement facility by NAFID, merger of companies, bilateral investment treaties, and investment friendliness index of states. First of all, let me welcome all the participating departments.
This meeting is being recorded.
DFS, DEA, MCA, TPIIT, NITI Aayog, and other state government representatives and public financial institution representatives who have joined this webinar. We also have Professor Charan Singh, eminent economist, who is the expert on this panel and will help us in summarizing and present the details at the end of the webinar. Next, let me welcome all the panelists and active participants for this session. Ms. Vibha Padalkar, CEO, HDFC Life. Mr. Tapan Singhal, CEO, Bajaj Allianz General Insurance. Shri Rajkiran Rai, MD, NAPFID. Shri Ranjit Pandey, former President, ICSI. Ms. R.V. Anuradha, representing Claris Law Associates. Shri Anirudh Rajput, Professor of Law at National Law University. Shri Ashish Vora, President and Business Head, CRISIL Intelligence. Shri Ishwaran Subramanian, Partner, Deloitte. Also, I welcome the active participants, Mr. Deepak Kinger from ICICI Prudential Life Insurance, Mr. G. Srinivasan, CEO of Galaxy Health Insurance, Ms. Surabhi Goyal from Munich Re, Mr. Somashekar Vemuri, Senior Director, CRISIL, Mr. Vineet Mittal, Chairman, Avada Group, Mr. Devesh Pandey, Partner, General Corporate, Mr. Pranav Kumar, Vice President, International Trade Policy, Reliance Industries, Mr. Shreyas Jaisimha from Arana Law, and Mr. Rajiv Verma, Director of Samsung Electronics. I wholeheartedly welcome all the panelists and other participants into this webinar. So the areas which is basically for this group is to discuss on making India investment friendly, the announcements around that. The reforms aims to streamline business operations, improve access to capital, and enhance the overall competitiveness of our economy. So we will start the webinar now. I propose that we have about 8 panelists. Each panelist, I'll come one by one in turns, can speak for about 6 to 7 minutes so that each topic is covered. And subsequently, we will have the active participants to ask questions or have interventions so that the panelists can respond to that for about 20-30 minutes. We will cover this in about 1 hour 15 minutes, and I would request Professor Charan Singh sir also to step in at the end and give a short thing about 2 to 3 minutes. Subsequently, a detailed summary of this will be presented to the larger group which we had in the morning, where honorable ministers will be present. So first, let me come to Madam Vibha Padalkar. One of the major announcements which has happened in this budget is about FDI in insurance sector. So there is a lot of interventions which have happened in the past, where FDI was increased initially up to 74% in 2001 when it started in 2000, and gradually it went up to 74% in 2021. So and now we have gone to 100% FDI. Your initial thoughts on how it will be useful and what are the key areas which should be looked from a policy and implementation perspective. Over to you, ma'am.
Thank you, Manojji, and thank you, DFS, for giving me the opportunity to speak on the proposal to increase FDI in insurance sector to 100%. What I will do is I'll just put up a one-pager while I talk about some of the key aspects in this. I'll just share this. Yeah. So our Honorable FM said on January 29th that India is expected to become the third largest economy in the world with GDP of 5 trillion in the next 3 years. And this would be on the back of continued reforms. One critical sector that will be the backbone to our nation's resilient growth is undoubtedly the insurance sector. During recent times of severe distress, this is due to COVID-19, the sector delivered as promised, making timely death claims over 72,000 crores. This was in the year 2022. In India's insurance market is one of the fastest growing in the world. In fact, Swiss Re projects that India, which is currently ranked at number 10, will be fastest growing in the G20 over the next 5 years. This strong outlook is driven by rapid economic growth, rising disposable incomes, a young population, greater risk awareness, increasing digital adoption, and forward-looking regulatory changes. That said, India still remains significantly underinsured. Consider this: the overall life insurance penetration in India declined slightly from 3% in FY23, a couple of years ago, to 2.8% last year. And this is even lower than where we were a decade back at 3.1% in 2014. And also much lower than some of the countries in the Asia-Pac region. Even more striking is that the sum assured as a percentage of GDP, this is kind of the real cover in terms of life insurance, that is just 85%. And this is one of the lowest globally, contributing to the protection gap. And when it comes to retirement security, this is on the other end of the spectrum, India lags behind because pension as a percentage of GDP is only 3% compared to close to 100% in some of the more mature economies. Having said that, undoubtedly, insurance remains a crucial part of India's financial landscape. As of December 2024, India's insurance sector consisted of 73 insurers, of which 25 were life insurers. To achieve universal access to insurance, which we all agree we need, India will need to increase its number of insurers. In more mature economies, there is one insurer for every 2 million of customers or citizens. In India, that ratio is almost 19 million per one insurer. Expanding this number isn't just about closing this gap, it's about ensuring financial security for millions of people. And DFS Secretary did allude to this, that we want to move towards insured society as we reach our 100th anniversary of independence. So with this backdrop, I would like to talk about the proposed 100% FDI in insurance. As I recall, and Manojji mentioned, that the insurance sector in India was opened up to FDI up to 26% in year 2000. This attracted flows of about 21,000 crores. This limit was increased in 2015 to 49%, attracting a further 35,000 crores. Thereafter, it was relaxed to 74% in 2021, attracting further capital of 27,000 crores. So a total of approximately 83,000 crores has come into the insurance sector. In the budget speech, this is FY 25-26, Honorable Finance Minister has announced that the limit for FDI in insurance could be considered to be raised to 100%. Also, some of the conditions which have been imposed so far will be reviewed and simplified. Now, I want to take this in three parts. Why is it in our interest to raise the limit to 100%? Number one reason is increase in insurance penetration requires large pools of capital. We currently have private insurers, 24 life insurers and private life insurers, one public sector insurer. We have a large network, 30 lakh individual agents, 11,000 branches, over 3.75 direct employee base, and so on. However, in order to increase the level of penetration, we do need to materially increase these touch points, especially in tier 2 and 3 towns. All of this requires large pools of capital, like I mentioned, both domestic and foreign. Second point is there's a long gestation period to profitability. It takes at least 10 to 12 years to first see one's money or break even. In fact, HDFC Life took 12 years to break even. So we do require long-term pools of capital, and there is only that many promoters in India that would be patient investors of large pools of capital. Companies are also struggling in terms of solvency levels, and that can be seen in the slide also right in the middle. There are several companies that are today way below 180%, although regulatory is 150%, but nevertheless very close to the regulatory levels. Third is to aid employment generation and capex investments. Today, the sector employs almost 33 lakh people, either directly or through agents and so on. And this is presence across 11,000 branches. This can improve and increase manyfold, which is also our objective to raise the level of employment in our nation. Fourth is funding our country's infrastructure needs. As of now, 70% of our nation's long-term borrowings, this is 30 to 40 year, and Secretary DF has talked about deepening of the bond markets. It's the same point I'm making. This largely comes from life insurance sector. And so as more capital flows into India, this can move into the bond market. This will also give rise to innovation, products, and so on. Now, what might be needed for India to be an attractive destination? Because we want capital very clearly, but what do we need to do? Number one point is regulatory stability. And this is important because investors, not only foreign, but even domestic, will need to be given the assurance that ultimately this is a good investment case. Of late, especially over the last 4-5 years, there have been quite a few paradigm changing regulatory changes, and that could be done in a different manner through consultation with the sector, and also to be done with very quickly. So that stability is very, very important. The other point, what is required is swift enactment of some proposals, such as moving to risk-based capital, moving to IFRS, listing roadmap, and so on. Last point I want to make is, while this is very clearly a requirement, however, we should look at both relaxing at the same time, keeping some controls. For example, key management personnel, maybe 2 out of 3 should be Indian, and this would be CEO, CFO, appointed actuary. 2 out of 3 could be Indian. While we can relax in terms of the board composition, still number of independent directors should still be maintained. I want to summarize here that the sector is at an interesting juncture. We will and we want to play an important role. Access to fresh pools of capital through the 100% FDI relaxation will certainly be the right step in that direction. Thank you very much.
Yeah, thank you, ma'am. Thank you for setting the tone of the this webinar by clearly articulating the need for FDI, at the same time having required regulatory stability, and at the same time having controls and having rules which are important, so that the government and the industry works together.
Thank you.
I would now request Mr. Tapan Singhal, CEO of Bajaj Allianz General Insurance to give his thoughts, especially on what are all the benefits that the general public can help in terms of, and the insurance sector as a whole can get out of this major announcement. Sir, over to you.
Thank you, Mr. Manoj, for the opportunity. It's an honor to be here. I think let me first put forward the point which is very useful for our country. When we talk of FDI and we talk of insurance penetration, what we should realize is that, let's say, if we talk of Viksit Bharat and becoming one of the largest economy of the world by 2047, and we talk of the growth, the current growth rate, even though it looks good, is still falls short. So one way, obviously, is to pump up avenues to grow. Other is to stop the leaking bucket, as I call it. And I did submit a paper in which at least 3 to 4% GDP growth can happen if we stop the leaking bucket, as I call it. And what are the leaking buckets? I'll just give 1 or 2 examples and why FDI is so important. See, if you look at the catastrophic loss and the loss to SME, MSMEs, and to the industries across wherever this happens, 90% is not insured. And even with the government funding, it doesn't make it up. The 2% loss to GDP every year is a World Bank study which shows that. Universal health for every citizen of India, if done, is a 1.5% loss to GDP which is happening currently because 10 crore Indians go below poverty line as it is not covered for. So if I just add a couple of things, it's about 3.5 to 4% growth of GDP which will happen if you have insurance for all in terms of individuals, industry across. So it's a huge impact. But can 72 companies do that? If they could have done it, it would have happened till now. A country like US, which in size would be like similar to India or a bit bigger, has 6,000 insurance companies. India has only 73. So I asked a couple of people to say that we have 100% FDI. Why don't you set up office in India? And I asked some leading CEO of the insurance companies globally. So first they said, we already have some presence through reinsurance. Why should we do so? Then I asked, it just costs you about 12 million USD to set up a company in India. Is it too much? They said, no, we didn't know this. Then I said that these are the reforms that we have. Are you aware about it? They said, no. And I think by the time I finished my conversation, I saw a huge keenness that they wanted to explore it. Then I was very curious. I went to Invest India website to check that is insurance as an investment a serious concern which the government has put up on the website or looking for investors. I did not find. Out of 40 industries listed there, insurance had no mention. I went to Niti Aayog also to check. So first point, Mr. Manoj, is if we want FDI to come into India, we want insurance companies to come in India, the first thing is people are not aware. So we are happy when we make an announcement. And neither the Invest India shows it, nor does the Niti Aayog have any page on that. We should put it together. And all put together in the entire world, there will be 8 or 10,000 insurance companies, not huge. We can get the addresses of the CEOs, we can get the addresses, at least send a mailer from the government side. And I've seen a lot of countries that look for investment. They're very aggressive in terms of laying out the red carpet. FDI, as we heard, about 84,000 crores have come. But look at the segments. When it was 26%, the maximum FDI had come. After that, it's still a small portion. Even 74 did not attract it. So why do we think, even if you announce 100, will this move up? So if you're serious about FDI, the first one I want to make is there has to be an effort on awareness, an effort to reach out to just 10,000 companies across the globe, not a huge demand, mentioning our strengths and why FDI. That would be the first thing. And India has the potential to absorb at least 1,000 insurance companies in the near future also because of the low penetration. Vibha mentioned that in a talk. But it's still low. So, and to say that 73 companies could have done that, we would have done it much earlier. That is my point. So about 1,000 companies should be there. And is it possible? Yes, possible. Will the FDI double or triple? Yes, possible. Will it impact the GDP growth of the country? Yes, possible. That is the first point. The second, if I look at why do we want to reinvent the wheel? Look at banking. Banking also is very critical for the common person. And let's look at India banking regulations and the way banks are structured. We have close to 2,000 banks in India. And in Vibha's talk, we heard that she said only 73 insurance companies are there in India. The different tier of licensing for banks of different requirements. You want to reach to the last mile of the country, and you only have one licensing, which allows it. So I think if we already have a structure which has worked so well in the country after so many years, we should look at banking and say, why can't we have tiered licensing? to reach the last mile. Why should we not internally also look at creating about 1,000 insurance companies in the Indian promoters, professionals, putting it together with expertise there. That's the second point, that we should learn from what is already working in the country internally also and do that. So now, if tier licensing would be one of the solutions to that. Third thing which we should learn. So first was awareness, second is licensing, tier licensing, third is value-added services. Now look at the profitability of the industry. It's bleeding. Now we talk to investors. Why would they want to come to a country where the profitability, is not very good and it's not very clearly visible? Again, look at banking. They have value-added services as inbuilt in which they can indulge in, cater to the services to the customers, add more services. Insurance by Act 1938 prohibits insurance companies to do anything other than just pure insurance. So the insurance industry has become kind of push product, and we hear all this noise in the market about mis-selling or pushing that. The only thing is the product is there, pricing is the only thing people are competing on. There's nothing that insurance industry can do. Value-added services, which we look at in the European countries, most countries have it, is very critical, which shifts the insurance from being a push product to creation of value, to solving a worry. Let's say if I tell you that I want to give you a product which takes care of your parents' entire needs when they're far away from you, you'll be very happy to buy it. And I tell you a health product, buy health insurance, your awareness to buy it was low. So the insurance industry is so constricted by the law that it really cannot open its wings and create opportunity to serve the customer well, bring value to the customer. So value-added services is something which is already prevalent in the European markets. The leading insurance markets of the world have it. In India, it's not there. So that is something, again, banking industry does it. They do it so well, well regulated. I do not see why there's an apprehension. Third point is value-added services should be very clearly set up there. Now, the fourth point, which again is very, very critical, is distribution. So let's look at distribution. Still so restricted, in the Indian market. Again, globally, if you look at, I can send you a paper, Mr. Manoj, but distribution is opened up, and as a player, the one which offers the best in terms of servicing products, innovations, is able to do so. So opening up of distribution should be something which again would encourage a lot of players to come into the Indian market and look at it, which is very, very clearly there. Fifth, if you look at capital, and we heard Viva did mention about in terms of the capital requirement, but there's a problem. The dividend repatriation, instead of the current process of regulatory approval being there, is also a big roadblock. And you can speak to some of the reinsurers who already set up an office here, and that is a big worry for them that they can't even take the dividend back. So if the solvency requirements are met, and we can keep a higher solvency requirement cutoff where we could allow dividend repatriation to happen, would also be something that they're looking at. Management control, for the first 5 years, I think a lot of players who come into the market, and I've seen it globally also, they want to put their people in terms of the CXO positions. So initially, first 3 or 5 years, we should allow that to happen, and then we can come in with the Indian origin thing we have. But the only thing is we can insist that they should be placed in India while they look at it. This was something, again, when talking to a lot of global CEOs on insurance, I think this came out very clearly that they wanted this to be a part of it. On the taxation part, again, the 25% tax is at par with other countries. So I don't think that's a major issue. The issue was GST, 18% on the product being sent. I think a lot of time we have mentioned that insurance is not a luxury product. It is something which is a very requirement of the country. As to the GDP, as to the, like Viva mentioned, 70% of the corporate, I think the infrastructure financing comes from insurance money, which is there. There's a lot of addition to it. So we should relook into the GST part of it. Also, we should look at creation of an insurance specific SEZ for some time. If we're looking at 1,000, 2,000 companies to come in, and we do it for other industries, but for insurance, we never heard that this was done. So that can be a serious thing again, that do we look at setting up an insurance SEZ on that basis. And then if I look at investment norms also, while we heard the talk in the initial stage when the finance secretary mentioned about insurtechs and but the reality is that insurance companies cannot provide investment at the unlisted or startups or insurtechs or their own thing. Then how do we encourage insurtechs? So while we make announcements and we are serious about it, but these changes have to happen to allow this to happen again from a perspective that it can take on to the next level. And then finally, if I look at the obligations which are set up in the Indian market, and be it TP or rural obligation, good thing, it should happen. But for new companies, it gets very stifling. So there should be a 3-year window in which we allow the new companies to set in before we take this on. So fundamentally, very excited about this FDI as an industry. This is something that we have always been asking for. Excited as insurance professional to see the 1,000 insurance companies come to Indian market and make a difference to the country. But if we do these spots, which I collected after talking to a lot of people across, then I came. In fact, Surabhi also is here in the call as the Munich CEO. I also asked her, and she said a very relevant point. She said that if you look at a lot of exits also, why people have exited from the market, there are 2-3 things comes out very clearly. Excessive regulatory scrutiny, slow profitability, high capital requirement. And she gave an example of UAE, like Zurich exited and Allianz also exited from UAE because of this. So if you're able to learn from exits in the global markets, if you're able to talk to people, create awareness, and not very complicated, create simple things, opening up distribution, value services, put in these small things, I think we can attract a lot of FDI and a lot of good companies to the Indian market to serve the Indian citizen. Thank you, Mr. Manoj, for the opportunity.
Thank you, Mr. Singhal. That was a very, very valid input, especially in terms of how the catastrophic insurance and the health insurance can add value in terms of GDP. And clearly you articulated the areas which we need to look at, like awareness, which is a very basic thing which should happen, that if we have made an announcement and if these are the things which we are doing, the entire industry should be aware about it. And some of the regulatory and the economic reforms which you were talking about. GST, of course, is a matter which has been under consideration for quite some time. I'm sure that will be taken up at the appropriate time by the GST Council and the appropriate forum. But some of the inputs like insurance-specific SCSZ are clearly novel. And I understand your point about obligations. We have to manage that because being a country where insurance penetration at the rural and the tier 2, tier 3 cities should go up, that's where some of the obligations comes up. But what can be done about it is something to be thought about, whether some time delays or anything can be given. And of course, we will, as a part of this webinar, we take all these recommendations very seriously, and we will have wider consultation on this. Thank you, Mr. Singhal, once again.
Thank you.
Back to you. Yeah. Now, from the insurance segment, where the premiums are collected and the money is available for investment, we move to the credit enhancement facility by NABFID, which is announced in the budget. So basically, how we can ensure this insurance money or any other large investor like pension funds are able to route the money into the bond markets so that their returns are good, their risk is managed. These are all things which we would like to hear from Mr. Rajkaran Rai, MD of NABFID. Sir, to you, please.
Good afternoon, Manoj sir, and all the participants. This is a very important topic when we talk of Viksit Bharat. Infrastructure plays a major role because of the investments in infra actually has the big multiplier effect. And if you have to have that Viksit Bharat of 2047, huge investments in infra are needed. And I'm sharing a slide. Yeah, hopefully you can see that. Yeah. See, investments into infrastructure are required to go up multifold to enable India to be a developed country by 2047. Just to put the numbers in perspective, while 2017 to 2023, we have spent about 67 lakh crores on infra, and it's expected to go up to 143 lakh crores from 24 to 30, because it's more than doubling. Now, while these numbers are very much achievable, how we fund this infra expansion becomes very critical. Now, at this point of time, we have an infra book of about 29 lakh crores that putting the SCBs and NBFC, IFCs together. About 13 lakh crores from the scheduled commercial banks and about 16 lakh crores by the NBFC, IFCs. They're not growing as fast as it is required because there is some saturation here and it is not very aggressive funding which is happening. So there are some issues in bank funding because this is a major area of funding the infra. One is the asset liability mismatches which commercial banks have. because they have short-term liabilities, and infra definitely needs a long-term funding because most of the concession agreements are like 25 to 35 years. So definitely the loan requirements are around 20-25 years, and generally banks try to restrict the loan commitment to maybe 10 to 15 years, which creates a big problem for the infra funding, but it is asset liability mismatch for the commercial banks. So then also like infra needs very specialized risk assessment for the infra financing, because generally commercial banks, because they do a part of exercise, so naturally for them to specialize in this area is difficult, because the institutions created specifically for infra funding, they have that capability of risk assessment, and that is where we are lacking, and now slowly this area is being built up. So now, since the banks are not the best source of infra funding, what is the alternative is the bond market. Actually, typically, long-term funding has to happen from the bond market, and particularly from the long-term liabilities which are available in the system. And 10 years back, this was not a very vibrant area. Now, we have just heard the insurance industry speaking about the Vibha Madam and Tapanji, and the kind of growth this sector is showing actually is phenomenal. It is there, if you compare to the bank deposit growth and the insurance and pension and PF funds growth, they are growing at almost double the speed of banking industry. So now with that in case, because they need actually, long-term assets, because that particularly from the bond market. And but this is not happening. This long-term liability, which we call the patience capital, has to find its way to the long-term infra needs, which happens in developed countries through the bond market. But it does not happen. And we just examine quickly how this bond market is behaving and what are the main issues. So basically, there are very low penetration levels as a percentage of GDP. In India, it is only 18% as compared to the other Asian countries. In Korea, it is about 80%, and in China, it is about 36%. So there is a lot of scope as a percentage of GDP, which for the bond market growth, we are very low penetration level as of now. Plus the bond market, the corporate bond market as of now is 43 lakh crores, is expected to go to more than 100 lakh crores by 30. In another 6 to 7 years, they are going to grow at a very high speed, and it will be more than 100 lakh crores. But here, when we examine, it is dominated by only AAA and AA issuances. And about 85% of that bond issuances are only AAA and AA. So typically, the infra bonds may not be at that highly rated level. So which is again restricting that investment flow there. So then again, in the bond issuances, the dominance of BFSI sector and public sector undertakings are much higher. And if you look at the demand side and supply side, actually on the supply side, when we talk of bond market development, we do not have much issuances apart from the BFSI and public sector. The infra bond issuances are very, very minimum. Even the corporate bond issuances are short term, like below 5 years, and from the very high rated corporates. So the supply side is also not robust enough, which we have to address. And the demand side, basically insurance and pension funds, which are looking for long term investments, they're not a big player here, particularly on the infra bond market. So there is a credit, like for the long term players like insurance and pension industry, that they need a minimum AA rating for investments, which is not happening particularly in the infra bonds, because there's a very low level of, the ratings are generally BBB or A rated. So that's where we are talking of the PCE facility to come in, because we have to address the market, because we need to increase the issuances, and also we need to enable insurance and pension industry to invest in this sector. And that is where the PCE comes in very handy. And this is a very tested product, but in India, actually, somehow it has not taken off for various reasons. So we'll examine those issues, why this is not taking off. So if you look at the PCE facility, it is designed to enhance the credit rating of bonds, enabling long-term capital providers to invest in India's infra bonds. So here, actually, what it does is it like a first loss. Suppose if I say 20% credit enhancement, it gives a first loss guarantee of 20%. Generally, the credit, like, a A-rated company can move up 2 or 3 notches to AA or AA plus, enabling insurance industry to come in. So then another area what insurance and pension industry faces is they lack the capability to do the credit risk assessment. Now, when NAFED-like institutions, which are sovereign entities, when they come in and do the credit enhancement, we'll also undertake that every 6 months or other interval, like frequent intervals, we'll also do the credit evaluation. The initial credit evaluation also is done. That every 6 months we also, because these are very long term, it is very important to monitor the investments. Since the insurance industry or pension industry lacks that evaluation capability, NAFED will undertake that every 6 months we'll put out a report on how this is behaving so that they can also have an assessment of their investments. See, this will help in deepening of the bond market and also on the supply side, increasing the number of issuances. But then why the PCE has not taken off? Because the first guidelines are issued in 2015 by the Reserve Bank of India. Some attempts were made to issue these bonds, but then somehow it did not happen because from the corporate side, it is basically what is it's a prohibitive cost which is preventing them from issuing the bond issuances. When we examine why the cost is high, basically the capital requirement on a PCE product is very high. Because we can understand it was mainly in 2015 when these guidelines are issued, the ecosystem then and ecosystem now has evolved. Now today the default rates have gone down, a lot of interventions happened on the concession agreements and strong counterparties have come in. With that, actually today we are in a very good situation where actually, the PCE can take off and the RBI definitely can look at relaxing some of those capital requirement norms. There are on the exposure side also, like today it is highly restricted, the kind of exposure I can take, even the individual exposure limits are 25% of the capital, but then exposure comes down to only 5% actually. When it comes to PC, again, it restricts me to issue, if I have 5,000 crore issuance, I need to find 2-3 partners to do the credit enhancement. So these are the things which we have taken up and hopefully, once these enablements happen, PC will definitely, take off. And then we need to get in some multilateral to backstop our guarantees. Basically, we are working with World Bank at this point of time. Now, what happens when this backstop facility comes in? Actually, the cost comes down because the capital cost comes down further with the kind of cover they provide to us. So then I think as a product, this will take off very well. And the cost will be such that many more corporates will come and the supply side will increase, providing the opportunity for the insurance and pension players to make more money. Because actually with all these facilities coming in, the insurance and pension players definitely, will find it interesting because right now, the major investment in AAA and the government securities, actually the yield is sub 7% or maybe slightly above 7%. So definitely this product will definitely give them that advantage of earning more income with much stable products coming in. So at the NAFED, we have already taken steps actually to launch the product. And we have also worked with the multilateral to ensure that the PPR report is already filed and is under process. Hopefully, we'll be able to get all that regulatory clearances and other issues so that we can launch the product as quickly as possible. But meanwhile, actually, we need to work on those enablers quickly because this product gets launched and we really expand the bond market to take care of the infra investment need of the country. Thank you.
Yes, thank you, Rajkiranji. So it was very valuable inputs, especially in terms of how the bond markets are evolving and how PCE could help in terms of deepening or bringing more issuers into the market, and as well as the investors, especially if PCE guarantor can give periodic reports about the bond issuers' performance, that will really help the investors also. And we take note of the risk management requirements, the regulatory requirements, and how such changes can help in bringing a successful PCE product. Thank you very much. And next we will move to another important topic of this webinar, which is around merger of companies. So in India, merger of companies are generally two-track now through the NCLT mode and the fast-track mode. Foreign companies have been recently allowed reverse flipping. So the question is that how do we increase the class of companies which can avail fast-track mode, and how we can put safeguards to ensure that the shareholders and creditors are protected. What thresholds should we create? So to discuss all this, I would now request Mr. Ranjit Pandey, former president of ICSI, to speak on these topics. Thank you.
Thank you, Mr. Manoj. Thanks for the opportunity to the ICSI for presenting this particular very important topic. I'll share my presentation here, just a slide. Making India investment friendly. As we are all aware that mergers are the tool for corporate restructuring, which creates synergy, help in expansion and diversification of business, and sometimes it is extensively used for the technological acquisition and upgradation also. Presently, we are into 11th year of the Companies Act 2013. And lots of initiative, as Secretary MCA has pointed out, that a lot of ease has been created, already been created for the stakeholder and corporate. However, with the experience, what we have gained in the past 11 years, further ease in the process is required and need of the hour. Government through MCA is always committed to provide ease of the processes to the corporate by reducing compliance burden. As Honorable Prime Minister has also mentioned in the speech that compliance burden and a lot of compliance requirement has been done away with, and also timely disposal of the corporate actions such as corporate restructuring, mergers and amalgamation. Taking this motto forward, para number 101 has been incorporated in the budget announcement 2025-26. I quote the announcement first. Requirement and procedure for speedy approval of the company mergers will be rationalized. So that is one. The scope of fast-track merger will also be widened. Number two, and processes be made simpler. So these are the three broader highlights which has been there in the budget. How to achieve, how to take this objective forward, and how to align the budget proposal, take it forward. The recommendation which can be considered by the Ministry of Corporate Affairs and Government of India. One is consider enlarging the scope of fast-track mergers based on other criteria. Maybe some threshold can be decided, paid up capital, turnover, or any other class of criteria like mergers of the companies under the same management or same group, or maybe mergers of the subsidiary of a listed company into the listed company, because listed companies in any case subject to a lot of scrutiny, and it is wholly owned subsidiary or subsidiary of a listed company. So shareholders of the unlisted subsidiary are gaining out of this exercise. Wholly owned subsidiary of listed company can also be considered for the merger. Second is in the fast-track merger itself, dispensing the requirement of sending the notices of RD official liquidator on the multiple occasion and person affected, because this particular process enlarge the timeline by 30 days. So if this will be done away, then 30 days timeline can be reduced and process will become more speedy and faster. Third is ease of shareholders approval by inserting 3/4 majority present in voting instead of 90%, because it is actually taking the approval of the 90% shareholders in the fast-track mergers are one of the most cumbersome exercise. Fourth point is extensive use of e-governance tools for speed up the process of sanctioning of scheme, like aligning the NCLT portal or NCLT registry with the all other regulators, so that same day communication of the reports can be given. Another point I want to highlight here is that, of course, sanctioning of schemes, as stated in 233 subsection 5 of the Companies Act, which says that interest of the public and interest of the creditors, whenever there is an objection towards this, regional director is required to submit and forward this case to the NCLT. Taking a clue from here, we can give most of the cases to the regional director for the administrative intervention and resolving and deciding on the, say, interest of the creditor and shareholder. So that scrutiny can be done at the first level there only. And if at all regional director thinks appropriate that this is require larger intervention of the tribunals and some judicial, say, interpretation is required, then that matter can be forwarded to the NCLT. And that those kind of, say, rationalization between the two streams can be done. Lastly, extending this NCLT route, what I suggest that under NCLT route, where there are many subsidiaries or many other companies having the jurisdiction in the different states, then sanction from all the NCLTs are required. This can be streamlined and sanction for one NCLT where transferee company is located. That particular part can be given here. So by doing all these, definitely broadening the fast track merger will help the consolidation of business. At the same time, it will declog the NCLT, which is already burdened by the IBC cases and all other cases. It will reduce the timeline for sanction of such corporate actions like mergers and amalgamations. Thirdly, it will initiate the help in the expansion of the new market, technological upgradation, demergers, consolidation, diversification, and thereby it will definitely attract more investment to India and make India more friendly, investment friendly destination. Thank you so much. I wanted to share this much. Thank you for the opportunity.
Thank you, Ranjit Pandey. So, I mean, these are very, very valuable inputs, especially on the process improvements which we require, and use of e-governance, which we have already put in place the system, so it can be leveraged better, and lower levels of decision making, which will make it faster. And I am sure the Ministry of Corporate Affairs is looking into all these aspects. And from a government perspective, we understand that this is one of the major reforms which we will require in making India investment friendly. Thank you for your intervention. We will now move to another important aspect of this webinar, which is bilateral investment treaties. So bilateral investment treaties basically provide a reciprocal commitment to protect the private foreign investment in each other countries, as we all know. So India has been having bilateral investment treaties since 1991, when the economic reforms have started. And I think the model was first released in 1993. And it's the last review, it's almost 10 years after the last review. So a need has been felt to review certain clauses in our model BIT. So with this background, I would now request Ms. Arvi Anuradha from Claris Law Associates to share her thoughts on the topic.
Good afternoon, sir, and thank you to the fellow panelists and for the excellent intervention so far. I would start off, and Anirudh and I would be talking about some of the thoughts that we had on this specific issue. I'm sharing a screen of a few broad pointers in order to just structure the thoughts on this. Now, the specific topic that has been given to us as the budget promises is a revamping of India's BITs. And the angle from which I wanted to approach this is the fact that both domestic regulatory reforms as well as India's approach in terms of the international negotiations are essentially two sides of the same coin, and they can't be seen in isolation. We have to have a comprehensive approach in terms of approaching it. And I think one of the telling and excellent examples was from Mr. Tapan Singh's very pithy point that he made in terms of the fact that how do we, what are the regulatory bottlenecks that need to be resolved, as well as transparency of the regulatory framework in terms of even just simply communicating to investors that these are the specific opportunities that are available. So the way I wanted to actually approach this topic was from the angle of, again, as I said, the two sides to the same coin, the domestic front and the approach that we could take as far as the international BIT negotiations are concerned. On the domestic front, and one of the common themes which has been running through the entire day's deliberations is the aspect of overhauling our regulatory environment, enhancing transparency. And again, a fundamental component of that is really investment facilitation. A number of issues relating to transparency, time-bound approvals, streamlining of the processes have been dwelt upon. But where I wanted to actually highlight is a couple of pain points when we come to the international level, in terms of the experience with BIT so far. As you correctly pointed out, in 1994 was when India's first BIT was entered into, but it was only towards the end of the first decade of this century that we started, that the bite of the BITs really started in terms of the disputes part of it. So one of the key components that need to be addressed when we talk about the domestic level regulatory reform is the issue of grievance redressal and dispute prevention. A number of excellent ideas on this have been discussed in relation to various sectors, but the key ones that I wanted to highlight is the importance of having mechanisms within the country such as ombudsman, some kind of grievance redressal committees that can be set up, which are sector specific, that can redress both domestic investor as well as foreign investor related grievances in a timely manner in order to have a smooth flow of investments. The other aspect I wanted to highlight was the awareness, not just in terms of the opportunities that investors have, but within our own government departments, within both state and central levels, a mechanism for greater awareness on what are the sensitivities in terms of both executive action as well as lawmaking. And what do I mean by this? This is particularly given the sectors on which we are expecting greater investments, whether it is insurance or whether it is sectors such as mining, telecommunications, energy, transportation, water, sanitation, so on and so forth. In a number of these areas, if at all there is any modification of law or modification, if it is a PPP form, any kind of change in law, any kind of modification, any executive action which can impact the investment, we need to be first assessed from the lens of what are the possible fault lines. Is there a possibility that there could be a breach of an international commitment because of a domestic level action? This again needs to be imbued into lawmaking as well. If there is an amendment or a new law that is being thought about, how does it need to factor in the possible risk factors, and how can it be better designed? Because at the end of the day, legitimate policy making and decision making is a given. It is sacrosanct. But how do we hedge the risks of making sure that it can be better designed so as not to step on that fault line? That is something which needs to be achieved through greater capacity building at both the state and central levels. And then, of course, the final aspect is, disputes can't always be avoided. So if a dispute does get triggered, what could be a checklist for actions in terms of most trade and investment agreements that India enters into have as a first stage a consultation phase. In most BITs, this is a 6-month period. This needs to be very, very carefully utilized in order to make a clear assessment of the legal claims of the private investor, a clear legal analysis as well as a cost-benefit analysis in terms of the pros and cons if we were to settle the dispute or go ahead with the entire arbitration process itself. Obviously, in egregious cases, frivolous claims, abuse of process, it is the country just needs to fight. But there could be situations where a more amicable solution could be found in the form of a settlement. And this aspect, in my view, has not been effectively explored enough, and this is something which needs to be imbued as part of the legal and case management strategy itself. Now, coming to the international level, how does all of it, inform India's approach to the bilateral investment treaty itself? And this is where I would actually propose a slightly more radical approach of a complete revamp of our BITs from their existing form to one which can actually dovetail with the points that I made on the domestic level suggestions, which is essentially look at an investment facilitation approach to BITs rather than something which is purely designed as an investor protection alone. Now, we have an excellent example of this in the Investment Cooperation and Facilitation Agreement that India entered into with Brazil in 2020. It has some valuable provisions relating to streamlining of approvals and also the domestic level dispute prevention procedures that I just mentioned in terms of ombudsman, joint committee resolution, as well as in the worst case scenario, have the possibility of an arbitral mechanism. But this arbitral mechanism is something which will be a state to state, a government to government arbitration through an external tribunal. But the preventive steps are so well laid out that the possibility of SSDS, hopefully, the expectation is that that would be a much narrower one. The reason I emphasize on this is because I think as part of the revamp exercise, it would be a valuable exercise to question whether India really needs an investor to state dispute settlement at all. This is an aspect which has been critiqued across jurisdictions, both developed and developing countries. There has been a rethinking and redesigning of approaches across the world. And this is something which needs to be considered very seriously, more in terms of whether at all a foreign investor essentially needs a level playing field with a domestic investor, or does a foreign investor necessarily need a higher right in terms of taking a state to a foreign arbitral tribunal? There are several pitfalls to this, and this needs to be considered fairly seriously in this entire revamp exercise. I do, however, also want to make the point that within the current framework of the BIT, there are, the concept note itself highlights some of the areas which have been pain points in ongoing negotiations. And on that, I would let Anirudh elaborate a little bit more. But the points that I wanted to broadly state is the necessity for having the enterprise-based protection, because that is what will give a clear linkage in terms of the seriousness of the investment that is being protected. A carefully worded minimum standard of treatment, which necessarily needs to be emphasized. The concept note had also indicated that the issue of most favored nation treatment is something which has been raised by several bilateral partners. Now, this is something which I fundamentally believe has no place in a bilateral agreement. A most favored nation treatment is necessarily a component of a multilateral agreement. A bilateral agreement is essentially based on balance of the rights and obligations of the two parties negotiating. At best, there can be consideration for requests from the other party in terms of benefit enhancement based on reciprocity and a balance of rights and obligations on both sides. Another key aspect is that of exhaustion of local remedies, and this again ties in with the domestic level dispute resolution mechanisms that need to be put in place. if that effort is made and a fast track mechanism is provided within the domestic level, there has to be a clear obligation which currently stands at 5 years. India in the BIT with UAE reduced that to 3 years. In terms of what can be workable, whatever period of time, 3 to 5, that exhaustion needs to be streamlined with adequate mechanisms at the domestic level so that it can really lead to a dispute prevention kind of a value and truly amount to an exhaustion and hopefully a resolution of any grievance. I would now like to hand over to Anirudh. Thank you.
Yeah, thank you, ma'am, for your wonderful thoughts. So basically, you have brought out both the domestic and international requirements, especially your point on awareness within the government departments and sensitiveness of lawmaking, which actually ties up to the overall objective of ease of doing business. And capacities at the state level of dispute resolution, yes, we understand that is there. And probably we could learn, as you said, from some of the developed countries' approach on how this has been, how they have been successful in some of the BITs. So I would now request Shri Anirudh Rajput, Professor of Law at National Law University, to throw some light on the topic, especially on the issues and challenges which we are facing and what are some of the clear early winners which we can look forward.
Thank you very much. I must begin by thanking the Ministry of Finance for organizing this event and feel very honored to be here. As Anuradha just pointed out, that there are two facets of having an investor-friendly environment. The first limb is the kind of regulations that exist within the country. That's the national regulatory framework in relation to foreign investment. And the second is what is the strategy in terms of investment treaties, the bilateral investment treaties. And I want to elaborate on both these limbs and how they can be used most effectively in order to convert India into an investor-friendly jurisdiction. Let me start with investment treaties and particularly the model bilateral investment treaty. The first general point that needs to be kept in mind is that any jurisdiction, a developing jurisdiction, which has attracted large amounts of investments, has never succeeded in attracting investments exclusively based on investment treaties. So what we have is a set of economists giving two completely contradictory conclusions. One set of economists saying that having investment treaties results into higher investment flows, and another set of economists saying it doesn't, and it is equally divided. If we look at the data for India itself, no need to just, because economists always tend to disagree. I mean, Maynard Keynes used to say, even I changed my view. So there's one more view by the end of the discussion. But let's look at a bit of hard data. I just went through in the morning the DPIIT data, the latest data on investment inflows. The largest inflow of investment from Mauritius and the largest gross inflow of investment, which is 53% of inflow of foreign investment, is from the jurisdictions with which we don't have any investment treaty at all, starting off with Mauritius. The second greatest exporter of capital to India is Singapore. But with Singapore, we have what is called the CRECA, which is a fairly narrowed down investment treaty, which is not a broad investment treaty. So if we look at the top 5, except Singapore and Japan, Japan is actually using a business, the enterprise-based definition which exists in the current model bilateral investment treaty. So if we look at the total inflows of capital, they are far outweighing from jurisdictions which do have a bilateral investment treaty. So for us also, the data indicates that the presence of a bilateral investment treaty is not necessarily an incentive for investors to invest in a jurisdiction. But then what purpose do investment treaties serve? Of course, they are an indication, but most importantly, a dispute resolution clause is only a mechanism of last resort. Investor would not like to file an investment claim unless things have become really bad, which means that if disputes can be caught and resolved much before they aggravate, then the need for having or going for investment treaty arbitration would not even arise. And I think Chinese example is quite apt in this example. What the Chinese started doing was they had very narrow investment treaties. The only dispute resolution avenue was on the amount of compensation which was given by national courts on expropriation. Apart from that, no issue could be brought before an investment tribunal. That is an extremely narrow jurisdiction to an investment treaty, a treaty tribunal. But as China changed from majority capital importing to capital exporting, it changed its policy and then started expanding its treatment standards. So the idea of expanding treatment standards begins when a country becomes a predominantly capital exporting from a predominantly capital importing country. And as I understand, our priority at the moment is to emphasize capital imports. Therefore, we have to keep that in mind as we start reforming the Model Bilateral Investment Treaty. Now, in terms of the national level reforms, Anuradha has already made some point. I want to add 3 points. The first general point is we need to have a dedicated national law on investment promotion. It could be called, say, something like Foreign Investment Promotion Act, Investment Friendly Act. This act needs to do 3 things. First, it has to facilitate investments. So it has to have a clear track, path, which foreign investors can follow, which is going to facilitate the making of the investment. Second, it needs to have early catch and address mechanism. That is, try to catch disputes as early as possible and resolve them through an ombudsman or any other mechanism which is non-adversarial. And the third is to have an effective national level dispute resolution mechanism, which could be either in the form of one bench of NCLT could probably take up that task. I understand they're already burdened, but it's important that that particular bench has to be focused with skills on resolving foreign investment disputes, plus with a time-bound process. And I think it would be very helpful to look at things like multi-track process, which is used in England and Wales for dispute resolution, or in Singapore, which reduces the timelines for resolution of disputes, which will also ensure that the disputes are resolved in a quicker fashion. Also, I must add that this act would indeed address situations post-market access. That is, once an investor has made an investment, because the market access issues of automatic and approval route would be regulated at other fora. Let me briefly touch upon what could be the potential reforms into the Indian Model Bilateral Investment Treaty. Since I was involved in the drafting of the Indian Model Bilateral Treaty in 2015 at the Law Commission, I'm quite intimately aware of the discussions which went on, why it is a certain way that it is. And I feel quite pleased. A lot of academics, practitioners around the world come and tell me that a lot of developing countries are using that model because it is a template for a country which wants to import capital, not for somebody who wants to export a capital. Then the idea would be quite different. Let me just highlight what could be the potential tweaking in order to facilitate investment in light of the note which has been circulated. There was a suggestion in the concept note that possibly we should move from an enterprise-based definition to an asset-based definition. What it means is an enterprise-based definition requires the investor to be here, physically present. But an asset-based definition allows bonds and other things and other kinds of investors also to have claims. But let us look at the practice which is evolving globally. CETA, which is considered to be the most advanced treaty, that is the Canada-EU Free Trade Agreement. CETA is not following an exclusively asset-based definition. It has an asset-based definition, but then it adds certain more criteria, which are almost in the direction of an enterprise-based definition. So which we do see that an enterprise definition is something which is becoming popular. Also, we have to be very careful, because if an asset-based definition is used, in fact, Peru had a recent case where certain bondholders who bought agriculture bonds 30 years back came back and filed a claim, and not just claimed the amount which they had invested plus interest plus potential profits, and the state had to pay a large amount in return. That also, and as I already referred to the India-Japan FTA, which is using an enterprise-based definition and not an asset-based definition. The next point, which is in terms of substance, is whether we need to include a fair and equitable treatment standard. I won't get into the technicalities, but fair and equitable treatment standard has been a major issue for several developing countries. If you look at the recent FTA between India and Switzerland, we don't have the free trade agreement, or the ASEAN agreement on investment promotion doesn't have a free trade agreement. What we have in its place is a very specifically defined set of clauses. So I think if we move on those lines, that's possibly we can move. Also, we need to be careful, and that's the last point I'm going to make, is investment tribunals follow what is called the DCF method, direct cash flow. The effect of that is, if you lose one big case, it might wipe off most of the investments that you've got. There are examples of Ecuador, which lost its entire health budget for India. So we have to be careful, balance it out, be aware that regulatory freedom may not be always approved the way we expect it to be. So we have to be careful, and there are ways in which we can find mechanisms to resolve this issue. My apologies for going for a little too long, but I don't think it was too long. Thank you.
Thank you, Rajputji, but I don't think it was too long. But yes, considering the overall timelines, I would quickly move into the next topic, which is investment friendliness index of states. So the competitive and cooperative federalism comes into play here. So I would now request Shri Ashish Voraji, President and Business Head of CRISIL Intelligence, to share his thoughts on this.
Thank you, Manojji. I hope you can hear me well. Great. I'm just going to put up one panel, that I can actually talk through. I hope you can see that.
Yes, we can.
Perfect. So what I'm really going to talk about is, as the sub-theme is, which is, development of a framework which really will help us roll out an investment-friendly index of states. I have my colleague, Mr. Ishwar, also going to be joining us, once I'm done with my section, and he's really going to talk about, some of the initiatives that need to be taken in order to make, India investment friendly. So it's really been broken up into two parts. As a quick background, we heard Mr. Shri Sarjeet Singh emphasize a little earlier this morning that there is a lot of variability at the state level in investment policy, in taxation structure, and also in the infrastructure, making it very difficult for investors to be able to predict in terms of which state they should really go to and where they will really see long-term returns. He also kind of highlighted some of the various steps that are being taken by the central government to enhance India's competitiveness. Now, while all of these are national initiatives and they kind of create a conducive environment for investment, the ultimate destination of investments is largely determined by the states. And therefore, it is quite crucial to evaluate each state's, evaluate each state's investment attractiveness and then kind of benchmark them across multiple parameters to facilitate informed decision making and targeted improvement, depending on who the stakeholder really is. And I think this is where the whole investment friendliness index of states comes into play. It kind of provides a comprehensive framework for assessing the investment ecosystem. And like the Honorable Prime Minister mentioned during his talk, it will also help foster competitive and cooperative federalism. So it's with this background in mind that we've been working on this critical initiative to roll out an investor friendliness index of states. I'll talk a little bit about what the framework should really look like and what one is really thinking of. It kind of will adopt an, in investor-centric approach, which is, you're essentially looking at key factors that influence investment decisions, which if you really look at it broadly, it falls under two categories. There is opportunity and risk. So the idea is to do a thorough assessment of a strait's opportunity and risks, encompassing evaluation of, the infrastructure, the incentives, both fiscal as well as any other type that they have to offer, the resources availability that is there in the state, and the enabling environment that the state really provides to determine the potential impact on the eventual investment that comes into. Furthermore, what we are also one is also looking to do is to assess the risks related, and the risks could be with respect to the regulatory environment, on which anyway a lot of work is being done to be able to mitigate that, and we've heard about that all through this morning. Any risks related to financial position or any other factors that could that could affect both investments as well as operations. It could be something as, it could be climate and, areas like that really. So the idea is by weighing in some of these parameters, which are categorized into opportunities and risks, the stakeholders can make informed decisions and develop strategies to move. I'm sorry, there was a phone coming. My apologies for the disturbance. By weighing some of these factors, the stakeholders can make informed decisions and develop strategies to mitigate the risk and capitalize on some of the opportunities, and thereby ensuring a successful and sustained presence in a particular state. So what does the index really comprise? While it's two categories and there are a bunch of parameters that we've really got, what we're really saying is that there should be a mix of secondary parameters or secondary indicators, which could be hard data based, but then you also need to overlay that with a layer of primary perception based indicators, because perception, as you know, is quite important to factor in. So the secondary indicators will carefully be chosen, which are relevant, they are measurable, and they're available at a recurrent frequency. You don't want something which is, coming at very sporadic or very, very long kind of gestation gaps. On the other hand, the primary perception parameter-based indicators is really more about capturing feedback from investors and from various other stakeholders in areas such as quality of infrastructure, time taken to get approvals, and so on and so forth. So you kind of merge both of those, both the secondary and primary, to come up with a bunch of parameters that are relevant. Now, it is also very important that we get the right stakeholders to assess some of these perceptions. Essentially those which, people who are investing there from a long-term basis, somebody who's a potential investor who could potentially come in and bring investments to the state. We don't want to keep it, to a single cohort, if you may want to call it that, only people who've really invested. We really want to try and make it as 360 a view as possible, really. And once this crucial exercise is really over, we can harmonize or homogenize the diverse set of indicators onto a common scale. So that you can compare the output of one state vis-a-vis the other state without any biases at all. What does the output really look like? And when it comes to output, I think the index will need to be made not only from a diverse set of stakeholders, and hence it should, and when I say stakeholders, it could also be the state. And hence you may have to strike a balance and be categorized into manufacturing, services, and infrastructure. It could even actually be broken up into states based on their size in geography, and for a like-to-like comparison, and in the indicator selecting something which will help normalize it for the smaller states, so that they're not disadvantages or not put into a disadvantaged position. Lastly, to serve the purpose of continuous improvement, the parameter insights or the scores at each parameter will have to be assessed over a period of time, because what you really want to do is you just don't want to do this at a point in time. As you do it over a period of time, one will realize in terms of which parameters is the state improving on, which parameters is the state bad on, and hence needs to improve on, and what are the actions that are taken in order to be able to improve. And that's how you're going to increase competitiveness across the states. So finally, what does it really offer to the stakeholders? If you look at the states, really, it's a comprehensive assessment of their current position across multiple parameters, which are important from an investor viewpoint. It will provide a framework for evaluating their own performance and identifying areas of improvement and receiving feedback from investors through perception-based indicators so that they can take action based on that. And then finally, to be able to formulate and prioritize key performance indicators that they really want from improvement by looking at what some of the other states are doing, and which is what is really going to foster the competitive, so to say, aspect of how the states react to this. From an investor perspective, it's really a nuanced understanding of the quality of infrastructure and some of the other benefits that the really state has to offer. Beyond just a report or something like this is something which will give you a sense in terms of how states are performing over a period of time based on certain indicators. And finally, there's a trade-off across multiple parameters based on what the investor really wants to do, in the sense in what are they really investing for, so that they can take an informed decision that this is a state that one may really want to put their investments into. I think the idea is to move away from that concept is big is better, or that's and there is nothing else, or there are no other states that one can really invest in. So I think net by providing a data-driven framework for evaluating investment attractiveness, I think the index will facilitate informed decision-making, foster competitive federalism, and ultimately drive growth of the economy. Yeah. So that's what I had from Mr. Manoj. From my side, I'm going to give it to Ishwar to talk a little bit to some of the initiatives that are being run in order to make India investment friendly.
Yeah, thank you, Mr. Vora. Thank you for your valuable inputs. I would now request Mr. Ishwaran Subramanian, partner Deloitte, to give his thoughts.
Thank you, Mr. Manoj, and Ashish. Thanks. Am I audible? Am I fine with the audio?
Yes.
Perfect. So I think Ashish laid out as to how the index is extremely important for the states and what it can achieve. Just to give you a perspective, when the manufacturing GVA data was released by MOSPI the last month, you would find that about 53% of the manufacturing GVA was actually clustered in 5 industrialized states. And as Honorable Prime Minister said in the morning, I think the biggest dimension that we need to have is a very diversified manufacturing footprint portfolio, so that we are able to go to our aspiration of a 25% of the GDP from manufacturing. And then as we do about $30 trillion in 2047, we have a $7.5 trillion manufacturing economy. The reason why it is important is economies of scale and scope, and those economies of scale and scope are very relevant for competitiveness. So that's essentially the entire starting point with which we really are looking at attracting investments, and therefore the investment friendliness for the states per se. So if I take the budget in specific to this context, and possibly I'll just share a very quick document for this, maybe a page or so. If you really look at our budget announcements, there are a couple of things which are important from the union budget's perspective. I think we started the day with the 4 engines. And if you really look at the 4 engines of growth that we are talking about, all of them are interlinked, and the most important of them is from an investment perspective, which is very much linked to MSME exports and agri. I think there are 3 aspects that we may want to think about. The first one is our national manufacturing mission. And if you really look at it and link it back to the data that I mentioned in terms of 5 states having 53% of our manufacturing GVA, this provides a real opportunity for states to accelerate their ecosystems and really take an additional 100 billion, because we are talking about 100 billion of FDI coming in, and really a strong focus on manufacturing. In the next 3 years, it provides us with a great opportunity, because many of the states really don't attract that much of investments right now from a manufacturing and therefore the employment perspective. So for that, we really need to reduce the variability across states in the ease and cost of doing business. And that's where I think the index in its totality will be very, very relevant for states per se. The second aspect of the budget and the NMM in perspective, which will be most relevant for the states, would be the focus of NMM on clean tech manufacturing. One of the advantages that we will have is that with all the global economies really looking at everything around carbon footprint optimization, everything from a net zero perspective, they're really focusing on having the entire value chain also to be completely on the clean tech journey. And that is where I think the states have an opportunity with this in context to really drive a focus on the entire value chain and the ecosystem from a clean tech perspective. Look at dimensions of clean energy, electric mobility, etc. All of that can make us access those markets in a very competitive manner. So the states have the second agenda of not just reducing variability, but focusing on the right levers for growth that the NMM is really enabling them to do. The second one, I think from the budget perspective that is very relevant to states is the focus on employment in intensive sectors. Predominantly, I would call out the four which are most relevant: leather and footwear, food processing, and toys. All of which together can really provide an employment to over 1 million people. And all of them have substantial export potential. So link it back to all the themes that we had so far, be it in terms of financial inclusion, be it in terms of reducing the regulatory implications for business, or for that matter, the investment friendliness index that we just talked about. All of them really drive towards accelerating the ease and cost of doing business as well as the speed of doing business, and therefore a very significant export potential. So I think this is the second thing, I think from a state perspective, that I think the budget has a lot of relevance for. So what do the states need to do? I think the states may want to really think about creating an ecosystem that captivates not just the revenue pool, but also the profit pool. It means that you create not just the core organization, but also the ecosystem around that. Only then we will also have the next lever that we spoke about, which is MSMEs. So investment together of the core organizations together with the MSMEs is where I think the states can really benefit. And what it does is over a period of time, we have seen in multiple countries, really creates a competitive advantage. Think of, let's say, semiconductor in specific countries or electronics in specific countries. I think the third, which is, in my view, a very important dimension is our nuclear energy mission. And it's linked back to manufacturing itself. Because if you're really looking at the NEM, 100 gigawatt plus of nuclear energy by 2047, 5 domestically developed small module reactors to be operational by 2033, which is in the medium term. And what it can really do is enhance the competitiveness of globally scalable sectors. And for example, things like electronics, manufacturing, semiconductors, capital goods, and electric mobility. And quite incidentally, we are not deviating from what we already have as a strategy in our country. I think the champion sectors that we have laid out are completely well aligned to the sectors that have the potential for global growth as well as for global acceleration. And finally, I think the last point, I would say the fourth one rather, that I would put, not the third, is the setting up of the export promotion mission itself and the support for integration with the global value chain. So I think if you really look at it's about 2% or so, and we have an aspiration for it to be about 10% and at least 5% in the medium term. And that is where the entire export promotion mission will be of significance for the states. So a combination of export promotion missions together with the nuclear energy mission, and that aligning to the focus on the employment intensive sectors, as well as the national manufacturing mission. I think these are four cornerstones, which if the states really take as the anchors for them to deep dive on a focus sector, focus market, focus competency model, and link it back to the investment friendliness index that Ashish spoke about, I think it will really accelerate on 4 or 5 things. I think move the GVC from the current 2% of global trade to about 10% of global trade, have the manufacturing GDP from the current 60% to 25%, which means that we are talking about manufacturing not being 500 billion, but really about 7.5 trillion that we spoke about, so a 15x growth. And obviously all this leading to highly skilled jobs. And if you look at the numbers together, we are talking about roughly about 100 million plus of highly skilled jobs that we can take. So I think the mandate from a budget perspective is very clear. I think the focus now should be on implementation across these 4 themes, and predominantly, as Honorable Prime Minister rightly said, there's a lot of activity with the states. I think they need to take this up going.
Yeah, thank you, Mr. Ishwaran, for this valuable inputs. I mean, it's really goes into the details of how this can be implemented, and I'm sure Niti Aayog is having a quick, a clear look into all these suggestions. So I would now get into the second part of the webinar. We are currently about 10 minutes, over the schedule. So we have about 9 interveners from all these topics. So I would request the interveners to be short, maybe about 1.5 minutes maximum, so that we close it in around 13 to 15 minutes time. So first I would request Mr. Rajiv Verma, I probably would go in the reverse order now, Director from Samsung Electronics, to discuss on the same topic on the index of states.
Actually, means I have the question regarding actually the bond market. So
yeah, please go.
There is less participation actually from the retail investor. So do we have any plan to increase the number of retail investors in the bond market? So are we encouraging some new platforms to be launched into the market to make them easily buy, manage the bonds?
I would request Rajkiran Rai ji to take this question, especially on how retail markets can also be enabled with the kind of enhancements and the activities that are being taken out in bond market.
Yeah, there is a lack of secondary market actually. That is what is a big problem. A lot of initiatives have happened. As number of issuances go up, actually that is what the intervention needed, because there is no sufficient issuances as of now in the market. So it is as I mentioned, the penetration levels are quite low. So I think as the number of issuances go up and the secondary market will develop, and we are also planning certain kind of structures to develop the secondary market. Sometimes the large institutions have to play a big role to initially handhold the development of secondary market. Once that happens, the retail participation is expected to grow up.
So any plan to enable the existing platforms like Zerodha, Angel One to actually include the bond related actually instrument, so that it makes it easier for the people to actually buy and sell the bonds?
Yeah, the suggestions well taken, but then what we do is we'll give, once we set up the structures, we'll give two-way codes so that the initial work happens. Then the other private players will come and take over.
Thank you.
Yeah, the point well taken. So how do we increase the retail participation, whether the existing platforms can be leveraged? That's a good thought, sir. So we now move to Mr. Shreyas Jaisima from Arana Law for his intervention.
Thank you for the opportunity and privilege to participate, sir. I have a pointed suggestion to make in relation to the suggestions made for foreign investor focused protection fora. We could make good use of the IFSC, sir. There is a report that has been submitted by the MS Sahu committee. It's pending, I'm told, with the Prime Minister and the Foreign Minister's, Surveillance Minister's office. It contemplates the creation of a commercial court. We can even have an international commercial court. And I think in this discussion so far, the IFSC has not featured sufficiently. There's a lot of effort that has gone in to create an accelerator. And the journey of $1 to $5 trillion is very different from 5 to 50 trillion. And therefore, we must, I would say, embrace, and I have a slightly note of some dissent with the approach to say, let us entirely avoid investor state protection, because this is a need for, let's say, nuclear or long-term patient capital. For them to come, they need investments, also the protection. Also, sir, we have the increasing interest of Indian investors who are globalizing with their investments, whose interest cannot also be entirely lost sight of while we're prioritizing develop India first. The easy midway point is that we have engineered is to have the IFSC, sir, and that can be better utilized. And please kindly look at the proposals made by the MS Sahu committee report. That is my limited suggestion for now. There are many other points which I would like to take offline. Thank you.
Thank you, Mr. Jayasimha. I mean, this is a very valid input. We will clearly look into it, and I'm sure the team will reach out to you for your other suggestions. I would now request Mr. Pranav Kumar, Vice President, International Trade and Policy, Reliance Industries, to give his thoughts.
Thank you very much, sir, for this opportunity. So I will be brief, and I have two specific comments to make. And first, in the context of Honorable Prime Minister's speech this morning, where he emphasized about manufacturing exports and also integration into GVCs. So, in fact, the previous speaker also mentioned about that. One important element which, of course, did not come up in the discussion, that is IPR, because when we are advocating for investment in high-tech manufacturing, then we'll have to examine that and try to see where are the leakage or gaps in the India's IPR enforcement. That is point number one. Second, that is within the context of the bilateral investment treaty, and that is important because the two very important FTA negotiations are happening. That one is with the UK, other one with the EU, and in both we have important component of BIT. Of course, with EU, this is a mandatory component because that is a part of FTA agreement, and with UK, it is being negotiated parallelly. Two contest point, of course, the speakers have mentioned about one is the dispute part and other is the definition part. But third important element that is extremely important, that is sustainability. And that is again, that did not come during the discussion since morning. Because Europe, for instance, has been emphasizing on sustainable supply chain. And of course, if we want to get integrated into the European companies who want to invest, then we have to prepare our domestic companies and MSMEs, those who want to sell their components, the intermediate products to large European firms. Then we have to create a kind of enabling environment to comply with those sustainability norms. This is also important from the perspective of, if you see the European Parliament requirement, because they cannot ratify any international agreement, whether it's a trade agreement or investment agreement, unless and until there is a provision of sustainability. So that aspect also we have to look at while developing our BIT. Thank you, sir.
Thank you, Mr. Pranav Kumar. So these are very, very valuable inputs which have come in, like IP enforcement, and especially in the current situation where sustainability has become a major important factor, especially in international trade. So these are factors which will help. I mean, inputs which will help us. I now request Devesh Pandeji, partner, General Corporate, to come in with his inputs.
Thank you so much, sir, for giving this opportunity to share our thoughts. I think it's a very welcome step to ease out and rationalize the merger process, and to include intention, of course, to include more companies within its ambit. So since there are two major objectives, I have just two suggestions and requests to make, since we deal with a lot of stakeholders, international and domestic investors, and I think it's the need of the day. The first one is, in case of a fast-track merger, just to ease out the process, which we see a lot of practical difficulty in, is the requirement to obtain creditors' consent, majority in number and 90% in value. So at least for the wholly owned subsidiaries where you have a parent company which can undertake liability for its subsidiary, this requirement may be considered to be dispensed with, given that there will be no harm to the creditors. Will have the benefit of having a stronger balance sheet. Their interests will be protected. Of course, the MC may consider taking an undertaking or an affidavit or any kind of undertaking from the parent company that they will discharge the liabilities of the creditors. That's one. And the second suggestion is on, of course, expanding the scope of fast-track merger to include fellow subsidiaries which are wholly owned by the same parent, which Ranjit ji has also highlighted in his presentation. That group company, given the intention is to facilitate easy merger within the group, so at least the wholly owned subsidiaries which are fellow subsidiaries may also be considered, in addition to considering the merger of a wholly owned subsidiary with a listed company. So these are the two thoughts and suggestions that I've had based on the practical experience and the stakeholder issues that we foresee in practical life.
Yeah, thank you, sir. I now request Mr. Vineet Mittal, Chairman Avada Group, for his intervention, please.
So, thank you for giving me the opportunity. We have been working on PC framework since the last decade, and we have issued one of the largest bond directly also by providing credit enhancement by putting in extra money. So we had done 1,800 crore bond issuance at 6.75%. But the issue today is that for PC to succeed, you need to have various stakeholders like RBI, SEBI and credit rating agency and multilateral agency and investor in the same room. Because today the challenge is that even in 2015 regulation, the capital required for banks or NBFC to provide partial credit enhancement is calculated based on difference between capital needed for bonds original rating and capital needed for bonds improved rating. So India needs a huge funding requirement. So this high capital requirement in RBI regulation makes it will not make NAFED's PC attractive for issuers. And also the current PC norm says that if you have ever used the PC, then you have to be repaid in 30 days. Otherwise, it becomes a non-performing asset. So these kind of issues will create more havoc in the bond market. Already the bond market is not so robust in India. And if this rules are not changed, then it will be very tougher. And the other thing which needs to be changed is at the regulator level, like any of the insurance company cannot subscribe to the bond from the private limited company, even if you are AAA rated. So even if you are AAA rated, they can't subscribe to your bond. So that also limits the ability of bond issuers to go to the insurance company. And almost 80% of assets being built in renewable energy and infra is built by the private companies. So that also should be considered. I'll send the detailed note on this one to you or whoever is collating, so it can be considered in the action plan.
Definitely, sir. We understand these are very valuable inputs, especially why PCS are not picked up earlier, and we should resolve all those issues before coming up with the next round of reforms or next round of progress. So thank you, sir. We will reach out to you and you can respond to the email which we have sent you in the initial thing. So that will be great to have, sir. I now request Mr. Somsekhar Vemuri, Senior Director, CRISIL, to give his inputs.
Thank you, Manoj. From a perspective of partial credit enhancement, it can really act as a bridge between what is the credit risk profile of the issuer vis-a-vis what is the risk appetite which is there in the bond market, which typically looks at AA category and above. Having said that, I think a point which my previous speaker also made, the extent regulatory guidelines are very, very prohibitive. Just as an example, if you take a 100 rupee bond and give a 20%, 20 rupee kind of a partial credit enhancement, and if the pre-enhanced rating was BBB, it goes to AA because of this guarantee. The capital actual that the provider needs to maintain is 6.3 rupees. And that, in terms of a risk weight, we would effectively calculate means 350% risk weight. Compared to that, a bank, if it were to lend to a BB category, it needs to maintain only 150% risk weight. So with this level of very high level of capital, it makes it extremely costly for the provider, thereby making the economics of the transaction a little bit challenging. Having said that, what we believe is that these are typically provided where the P&L rating is already at a BBB kind of a level. Now, BBB rating is achieved because there are sufficient cash flow cushions and liquidity buffers which act as a first level of defense and first line of defense, and hence the PC is something which needs to be looked at as a second loss and a second line of defense, and the capital treatment hence needs to be treated reduce the capital burden and make it economical. The other point that I want to highlight is that if you look at insurance companies, they are naturally the right set of participants to participate in providing long-term funding to the infrastructure sector. But the way their exposure limits are today there from a regulatory perspective, they can invest barely about 10%. The single borrower limit is kept to something around 10% of the overall balance sheet of the underlying borrower. So if an infrastructure project today wants to refinance a bank loan and then go to the bond market and wants to target insurance companies, they need to literally chase something like 8 to 10 insurance companies, even for a small issuance like 100 crore or 200 crore kind of a debt issuance, which is practically quite challenging. While exposure limits from a perspective make sense, it may need to be revisited and linked to the insurance company's own risk capital, like the way it is there in the banking system or NBFCs, rather than looking at the borrower's balance sheet and restricting it to 10% of the borrower's balance sheet capability. So these are a couple of points that I wanted to thanks for the opportunity.
Thank you, sir. I would now request Ms. Surabhi Goyal from Munich Re to share her thoughts, please.
So, sir, thank you for the opportunity. I just have one comment and one question. So, of course, with the introduction of 100% FDI in insurance, we anticipate increased competition and investment in the sector. Now, the industry is already experiencing a significant war for talent, and hence, as an industry, we will have to prepare for developing and nurturing a very strong talent pipeline to meet the growing demands and the expanding insurance industry. So this is just again, a call for action, to all the industry leaders on this. My question is really around the long-term sustainability. So, of course, now again, while 100% FDI will attract new capital and global players, long-term sustainability will depend upon a viable profit pool. Now, given India's, it's a very price-sensitive market with high distribution cost and got a very evolving risk landscape, what steps can be taken to ensure a sustainable and a profitable insurance ecosystem that remains attractive for foreign investors?
I request Madam Vibha to take that quickly, please.
Yeah, on the first point on talent pool, I think if we fix the business model, and I think several people have commented about regulatory stability, Tapan also mentioned about the need that we need to be able to make money as insurers. So anyone new coming in needs to have that roadmap. When all those things come in play, I think talent will follow. We have enough talent, but it's a question of whether our industry will be able to attract that talent. So I think it's that ecosystem of having a robust business model that doesn't fluctuate wildly that it has done over the past decade. I think talent will be adequate. And thereafter, I think, in terms of number of insurers and what kind of reinsurance arrangements and so on, I think I don't see them as headwinds as long as some of the things we discussed earlier in getting the business model right, it should be addressable.
Thank you, ma'am. I would now request Mr. G. Srinivasan, CEO, Galaxy Health Insurance, to make his intervention. Thank you.
Thank you, Manoj. Am I audible? So I have no question to the panelists. I'll just list out a few of the suggestions which can really make 100% FDI work. Because now what we have seen is 49 to 74 did not really bring in much capital. FDI is very critical for the insurance sector if we have to grow to reach insurance for all by 2047. The first point is on the AMP appointments, key managerial personnel appointments in the board constitution, the foreign companies should be put on par with the domestic companies. Second point is on the repatriation of profits. We have seen in the intermediary space where 100% FDI is permitted. There have been a lot of complaints about not being able to repatriate. I think this needs to be sorted out. The third is regulatory certainty is very, very important because what the foreign capital is afraid of too much changes, too drastic changes in regulations. That is something we need to take care of. The fourth is some of the global best practices like IFRS, risk-based solvency. which is practiced in most parts of the world. India is still to follow that, so that's important. The investment norms today are tightly regulated by IIDA norms and also Insurance Act. This needs to be slightly tweaked to make it a little more liberal. Then setting up process like licensing process, especially for the foreign investors, I think they generally find it a little more difficult as compared to domestic investors. I think that has to be made simpler if you want 100% FDI into insurance space. The other is open architecture for distribution. Because people with 100% FDI don't have the ability to distribute. So they would really look for open architecture if they have to really sell insurance. The last point is robust arbitration mechanism, because getting matters settled in courts takes a lot of time. So an alternative dispute resolution mechanism is very, very important. So these are some of the points which some of them have already been covered by the earlier speakers. Thank you.
Thank you, sir. Thank you for this valuable opinion. We'll surely take them into consideration and we'll reach out to you individually also. I now request Mr. Deepak Kinger from ICICI Prudential Life Insurance Company to share his thoughts.
Thank you, sir, for having us here. A lot of very good points have been made by the panelists and the speakers earlier, so I'll not, in the interest of time, repeat the points that I had. One point I thought that I could highlight here was that in terms of, reinsurance is very important for the sector. And while we measure FDI in terms of, the capital that's provided, reinsurance effectively in terms of, because insurance companies are ceding a portion of the risk that they bear to the reinsurance companies, effectively they are also mitigating the capital requirements to some degree of the insurance companies. So as policy, there should be some degree of measurement of that in terms of, because inherently that does reduce, the promoter's capital requirements that comes into play. And because of that, also in terms of the current attractiveness of reinsurers for India, in terms of, some of these efforts in terms of 100% FDI, some of the other initiatives in the bill and some of the work that the IID has been doing the last 1 or 2 years, I think it will bring greater attractiveness to the sectors. I mean, there have been a lot of inputs also today. Many most are valid, and we agree with those. Greater attractiveness for insurance because some degree of competitive play there. Because from an insurer's point of view, availability of reinsurance is also critical. If we have to ensure insurance for all by 2047, that's a critical part of the sector that has to come into play in a much bigger way. While all companies are, increasingly focusing on retention of the risk and including us, a significant portion of the risk is being retained, but reinsurance remains a critical piece of the puzzle. So some focus over there will help, sir. That's about it from my side.
Thank you, Deepak. I think we have had one round of discussions from everyone. And thanks everyone for the valuable inputs. I mean, the time which we have had was about 1.5 hours. We have almost completed that and probably overstepped a bit. But the discussions, the inputs, everything which came from you were really good and will be helpful in forming the policies and the programs and the schemes for implementation of these budget announcements. And I'm sure the rapporteurs of each and every budget announcement are there in this group. They are taking note of it, and we will reach out to each one of you and other larger stakeholders so that we get maximum inputs and the implementation is much robust rather than it remains an announcement at paper level. So thanks once more to everyone. So we will stay on. We will have Dr. Charan Singh summarizing our thoughts and presenting it to the larger audience, including the union ministers who will be joining the session. So we will wait now in the same webinar room and wait for honorable ministers to join. Thanks everyone, and it was really wonderful having you here.
ये दिखाएगा good afternoon, everyone. Prashant, can you hear me? Mr. Rajkiran, can you hear us?
Yes, sir. I'm able to hear you, sir.
Okay, you are
We
able
can
to
hear you.
Okay. I think. Okay. All right. If I think they must be separately. Now we'll be waiting for the honorable ministers.
Try again. Please enter the PIN followed by the pound key. Please enter the PIN followed by the pound key. Please enter the PIN followed by the pound key. Please enter the PIN followed by the pound key. Please enter the PIN followed by the pound key. Please enter the PIN followed by the pound key. I haven't been able to connect you. Goodbye.
और ये देखिए अपना वीडियो सिस्टम ऑन करता हूँ, देखिए अभी दिख रहा है ठीक। माइक माइक भी दिखा। Hello? Hello, am I audible?
Yes, sir, you are audible.
Secretary, sir? Yeah, you are audible. Hello? So you should leave this group, sir. That group will be. Hello, Prashant? Yes, DFS? Okay. Pankaj? Joint Secretary DFS?
Sir, I
They are not joint.
am here, sir. I can see.
Yeah?
Sir, Sharma, I am here, sir.
Okay. So all of us are here. Okay.
request everyone to please switch on the videos, please.
Good afternoon, everyone. While the Finance Minister joins us in a short while, we will commence our scheduled program. Now, as all of you know, we have requested 3 experts in these 3 sub-themes to prepare a summary of the discussions and also the conclusions that would be necessary or as recommendations for implementation of the budget announcements made by the Honorable Finance Minister. Now, we have Dr. Charan Singh, CEO and Founder Director, IGROW Foundation. And we have sub-team 2, Mr. Madhur Fadnavis, I think everyone knows, the Chief Economist in Bank of Baroda, and Professor Padare, Director, NIBM, Pune. Now, I request Dr. Charan Singh to make his presentation on the sub-theme 1. Thank you.
Hamish, good afternoon, and thank you so much for this opportunity. How much time do I have, please?
You'll have about 12 to 15 minutes, each one.
Sure. So I'll just open my PowerPoint. So first of all, once again, let me thank DFS and Mr. Nagaraji to have given me this opportunity to share these thoughts with you. Most importantly, making me a part of the whole scheme of things. I've benefited so much from the rich discussion and the participants who have brought in so much knowledge on the table today. I think we have had a very good discussion since morning on the various topics that were assigned to this group. The number of speakers who have given us their thoughts right from the morning, from the experts who came, and then who spoke to us before the Prime Minister spoke, and then, of course, the discussion that took place. So I would first like to take the paragraph on FDI in insurance sector. I think a very rich discussion happened there. And the issue that was most importantly discussed there was about reinforcing the commitment to 100% FDI by ensuring investors having complete control over their business decisions and expansion strategies. The issue that came up was streamlining approvals, eliminating redundancies, and providing clear, predictable guidelines for foreign investors. The idea of having many more insurance companies than just 73, and the example given was that in America, which has a population of just about 33 crore, they have nearly 6,000 insurance companies. and we have only 73. So we have to have many more insurance companies, at least 2,000. And if we are going to have that number, we need to incentivize and need to have an insurance specific special economic zones dedicated to the insurance sector. And we could expand GIFT City role as a global insurance investment hub. I thought that was an excellent idea that came out of the discussion. We also spoke about the different tiers of capital requirements and therein implementing a progressive capital structure where new and small insurers have lower initial capital requirements, enabling market entry. And I think that's very, very important if we want to have a competition in the insurance market. And the example given was of the banking sector, how we have changed the banking sector in the last 10 to 15 years, brought in so much of competition. We need to do the same in the insurance sector. The other one was, and I thought that was also very important, and that was regulatory and tax stability, maintaining consistent tax policies. And that I thought is also important because we need to have a regulatory stability, maintaining tax policies and compliance norms to provide long-term confidence to foreign investors. One illustration given here was on the GST, and the mention was made that GST of 18% is little higher, and that needs to be brought down and at least revisited. Then there was another suggestion made, and that was on the domestic reinvestment, offering multiple avenues such as long-term bonds, investment in fintechs and insurtechs, and infrastructure projects to ensure full domestic premium reinvestment. I thought that was another very good suggestion. And then, of course, with the AI and ML overtaking every other thing, to integrate the AI, big data, and insurtech solution within the regulatory framework to improve risk assessment, claims management, and customer experience. The thought about the increasing the number of insurance companies, which I have already mentioned, we need to allow more foreign reinsurers to enter the market, improving risk capacity and competitive pricing. I think with these suggestions, we could revolutionize our insurance sector for the Viksit Bharat thing. Also, some suggestions were made like value add services, how to add value on distribution. One issue that was brought up was the awareness. The foreigners still do not know the way we are opening up our insurance sector, and therefore we need to do something more on disseminating the knowledge of the initiatives being taken in our country. I thought that also needs some attention. We then discussed, and this was a lengthy discussion, on about new bank for financing infrastructure and development, the credit enhancement facility by NABFED. And as we all know, that this credit enhancement is really necessary. Now, this circular of the Reserve Bank of India, which is dated 2015, 10 years ago, would need to be revisited. And therefore, to help in making the partial credit enhancement facility, which is extremely important to develop the corporate bond market for infrastructure, has to be encouraged. In that context, the suggestion came that the RBI circular probably would need to be revisited. It's 10 years ago. And in that context, the story of relaxation in the PCE limits under single borrower group exposure norms, which are presently limited up to 5% of the overall single borrower group exposure limit, needs to be revisited. Quite a few of these are dependent on the board approved, and therefore I think that also needs to be revisited. The capital provisioning may be allowed for the amount of PCE offered instead of the full face value of the bond, and PCA may be allowed for up 50% of the bond issue instead of the current 20%. This comes from the RBI circular. In case of joint offering of the PC along with MDBs, and I think that's another very good point, I'll come to it in a second, the risk weight for the purpose of calculation of capital should be 0% for internationally AAA rated entities instead of present 20%. There was a suggestion also on the risk weights of the PCEs. So, and I think that needs to be revisited. Again, for PC of municipal bonds, the aggregate cash flows of the municipal entity may be considered instead of individual projects, which may not be viable at standalone basis, but would be important for the improvement required for the betterment of the quality of life of the citizen. The suggestion of exploring risk-sharing mechanism with MDB, the multilateral development banks, to reduce the cost of PCE is also, I think, very good and needs to be considered, a suggestion that has been made. The insurance and pension fund regulators, and I think they are bringing in lots of money if we want to develop the corporate bond markets for infrastructure, and they have the money with them. We may have to bring out guidelines enabling or directing capital providers to invest in to credit enhanced bonds. That will increase the liquidity in the market. And regulators need to create capacity building platform for PC market participants. This will be facilitated by NABFID, that's the assumption. And the Ministry of Finance may look at launch of Guaranco after the PC market stabilizes. This will bring in lots of resources from Africa and Asia. And of course, this is a London-based fund which can help us. This may also be undertaken by NABFID. There was another suggestion made, and I thought that was very relevant. Once we are into it, NABFID will evaluate the performance and help in guiding the market. That performance evaluation could be quarterly or 6 monthly or even annual. And that will also encourage the participants in the market. One suggestion that came in here was how do we develop the retail market? So in the bond market, as you know, private placement has an important role so far, which has been curtailing the bond market development. Of course, G6 market has developed extensively, but municipal bonds market have not, and general corporate bonds have not. So how do we encourage the retail segment? That is, I think, very important. The next issue that was discussed was on the merger of companies and how do we really go for speedy approval of company mergers. That facilitates ease of doing business. The discussion here also was rich, and the issue was to consider enlarging the coverage of fast-track mergers. Many suggestions came in, but one suggestion that was really good was creditors' consent norms need to be examined. Should we still be at that 90% threshold? I think that needs a revisit. It could be probably undertaking from the parent company that all norms will be fulfilled and one need not wait. Second, the wholly owned subsidiaries with listed companies, can we facilitate that and cover it under the fast-track mergers? There was also the issue of considering removing the requirement of service of notice to the registrar of companies and official liquidators on multiple occasions in case of fast-track merger. I think something is on the anvil and being considered. And then to consider aligning, and this I think is again very good, aligning the threshold requirement for approval by shareholders and creditors for fast-track mergers in line with mergers sanctioned by NCLT. So it will bring in sort of a level playing field. And finally, to consider sanctioning of mergers by this will facilitate by one NCLT where transferee company and transfer companies are situated in different jurisdictions. So I think if a bench is there, that can really facilitate the fast merger of companies, which will then, of course, help in ease of doing business. We had a lengthy discussion on the bilateral investment treaty. though the concept paper had very good concept paper, had given us the background, but the lengthy discussion was also very fruitful. It's almost 10 years. It's time to evaluate. And the issues were, what is the emphasis on the BIT? Should investment be our cornerstone? And it emerged that necessarily with countries which we have BIT, we don't get all the resources. We probably get even from countries which are not part of the BIT. Though we have 83 agreements with the BIT, 83 BITs, 74 still operational. The other issue that came up was the dispute resolution has to be very, very strong, because the investment comes not because of BIT, it comes because of the larger issues, the friendly country, the growth generating country, the policies which are dynamic, and therefore dispute resolution has to be really, really fast and to be very good. And the third, of course, was, which came out, that European countries talk a lot about sustainability issues. So sustainability clause need to be built. So then the issue was, one more issue, that should it be enterprise-based or asset-based definition? And it emerged in the discussion that in the enterprise-based is sort of staging back a comeback. So then the issue was, the broadly framed BITs mean greater exposure to investment claims. India's 2015 model, good for India as a capital importing country, but different models, better for India as a capital exporting country, could also be considered. And the story of Mauritius and Singapore did come in. I've already mentioned, but track and resolve disputes of foreign investors should be very quickly resolved, and that really promotes investment facilitation by regulatory changes. The capacity building of ministries required to assess potential breach of BIT and design law has to be improved. There has to be a clear and a better strategy during consultation phase itself of how a dispute would be resolved, and cost benefit analysis to be decided at the time of settlement. There is this local remedies clause, 5 years generally, 3 years experimented once. So the understanding is in the discussion that 5 years exhaustion of local remedies may remain, but be enforced with a more efficient dispute resolution process and in much lesser time frame. There has to be caution in using broad interpretive clauses like fair and equitable treatment. Actually, they are not really needed in BITs. So this was discussed. And also MFN is not really needed in the BITs. Another suggestion on dispute resolution I thought was very good, and that was sort of having an ombudsman or an external tribunal that could be brought in. The last point that, of course, we are talking of revamping, rethinking and redesigning, so all these thoughts came in. But one issue that came up was that we need to be raising the awareness of it and the sensitivity of all this. Now, in that context, one issue came that when we modify our laws, we should be sensitive to the international laws, and could by accident anything happening or breach of an international law should be also considered. The last point which the group considered was the investment friendliness index of states, paragraph 105 in the budget, and everybody appreciated that this will take us a long way into competitive federalism, and this is really important because if India has to achieve its Viksit Bharat, it has to happen through the states, and states should have the skills and the models to compete and therefore seek improvement in their norms and capacities, and they need to compete to attract investment either from the other states or from across the world. So there were lots of suggestions that came in here, even in the presentation before the PM's talk and in the discussion which the group had. So the issues that came up were, the key issues that came up were, should it be the index that has to be formed? Should it be state by state? Should be. Should it be sector by sector? And when we say sector by sector, there could be some sectors which serve the purpose of employment generation, like leather industry, for which the budget had special provisions. So if employment generation is the emphasis, the index should capture that. Investment, infrastructure is going to be the focus, the index should capture that. So very systematically, the webinar showed that the government's unwavering commitment to enhancing infrastructure with a strong focus on sustainability is important, and that was considered. We also thought about significant outcome in formulating strategies to accelerate private sector participation in critical infrastructure projects. This friendliness index will help in that. Thing that was discussed, as I mentioned, that we will need to look into what are the key things that the government wants to focus on. Global value chain. If it is global value chain, we have to think how states are identifying and will play a role in those sectors that align with the global value chain. By linking these sectors to state and cluster developments, states can create economies of scale and ensure that the benefits of India's trade agreements are fully realized, enhancing exports and generating high-skilled jobs. So other than the job, even exports are an important thing. In the morning talk by the Prime Minister, he did emphasize on not only manufacturing, MSMEs, but also exports. There is also another thought which came in the discussion, and that was to do with the resources available with the states, and that will obviously bring in the story of the fiscal management of the states, as well as the resource base. And of course, the Finance Commission plays a role in that, so that in that index, that calculation will also capture it. And maybe the fiscal indicators like the deficit and the debt and guarantees would play a role. It has to be futuristic. So in the state index, the risks and the opportunities both need to be captured in addition to the traditional things like quality of infrastructure. One important issue that came up in this discussion was it should not just only be a static point of time, but it also should be keeping in mind the period over a period of time. So all these factors were brought in the discussion today. Thank you very much.
Thank you, Professor Charan Singh. We're grateful. Now, may I request Mr. Madan Sabnavis, Chief Economist, Bank of Baroda, to present the summary of deliberations and the recommendations the sub-theme 2 had. Thank you.
Thanks a lot, Mr. Nagaraju, and it's an honor to be here. Good afternoon, Honorable Finance Minister, ladies and gentlemen. I have a presentation which I will share. Is the presentation visible? Can you all see the presentation?
Yes, yes, please go
ahead. So we had this interesting session, which was basically looking at the ease of access to financial services credit, looked at the budget propositions. There were 3 of them, one concerning the Grameen credit score. The second was expanding services of India Post Bank, Payment Bank. And the third was KYC simplification. So let's start with the Grameen credit score, who provides quite a context out here. Let's look at existing framework. We have the Credit Information Companies Regulation Act of 2005, Credit Information Companies Rules and Regulations 2006. That's the background. We have 4 CICs. We have the case of all credit institutions which share credit information in a uniform credit reporting format prescribed by the Reserve Bank of India, with all the 4 CICs on a fortnightly basis. And the CICs can collect the credit information only from the credit institutions and can share only with the borrower or specified users. So what are the challenges out here? How do you assess new to credit customers? So it's one thing to say that if you don't have a credit record, how do I actually know how good you are? Second is the lack of formal credit histories restricting access to cheaper and affordable formal credit. So here's a case of saying that everybody does not have a PAN card. And if you don't have a PAN card, you don't borrow. If you don't borrow, how do I know how good you are? Then absence of access to ancillary data. Now, ancillary data, which we're talking of, is essentially about other prerequisites or other strengths which a potential borrower may have. It could be ownership of land, it could be an insurance policy, it could be certain purchases which you have made. So if you don't have all this information, if you have all this information, it'll be a kind of a delta which is there for you when one is trying to assess the creditworthiness of the borrower. Now, what should be the strategy here? We are saying that consultations with users of the score, that is the lending institutions, the developers of the score, that is the CICs, and other stakeholders by the RBI. So essentially, we're saying the Reserve Bank of India should get into a dialogue with these institutions. Identify representative and accurate information sources. That's, of course, very important out here. Identify rural borrowers to the CICs. That is something that can be done from the side. Have the consent management in place, consent from borrowers in line with the DP Act. Consider credit enhancements. Now, I think this is something which is important because very often you get a credit score which may be of a lower on the lower side. So how exactly do you enhance this? So since we're also going to talk about in terms of the Indian Post Payments Bank, can we probably use that account among the balances which are there to be some kind of an enhancement for a person who's seeking loan, that is, we're looking specifically in terms of this scoring. Educating customers on maintenance and enhancement of scores, that is, of course, an ongoing process. And last of all, from a policy point of view, regulatory changes which are needed. So I think this is in the domain of the Reserve Bank of India. Whereas, can we say that inclusion of ancillary data in definition for credit information? Because currently, if we're looking at credit information, it is primarily in terms of whether the person has defaulted in the past or not. It does not go into any other asset which may be held by the individual. Now, what could be the design going forward? Number one is to digitize credit scores of self-help groups. And this is something which came up in the discussion in the afternoon today. And once you're able to digitize these scores, you can do the same thing even for the individual members. Second is to have access to the financial data. So when you're talking of financial data, which exists in most cases, information from the PACs, from the self-help groups, any direct benefit transfer, insurance policies, utility payments, so on and so forth. Non-financial data, I think that is something else which is important. So we're looking at PDS data, any kind of household assets which you have, Mandi data. I think this could also be very important because if we're talking of rural India, we're talking of farmers who are selling the produce in the Mandi. If we're able to capture this data, that itself will help to give a higher score to the individual. Data validation to ensure accuracy is the next one. Modeling techniques using AI ML, that is the way in which we use algorithms to make sure that we're arriving at a score. And then therefore we can say generation of score between 300 and 900 to keep parity with the existing credit scores. So this is the kind of a framework which could be recommended. And in terms of implementation framework, we should develop interfaces for easy integration with the loan application systems of lending institutions. That's number one. Two, continuous monitoring and updation mechanism for scoring model based on performance data, evolving financial practices and feedback. And we feel that this is something which could probably be rolled out in the middle of this financial year. So we're saying maybe by September, December is something where this could be rolled out. Next, if you're looking in terms of expanding services of India Post Payments Bank, this was the second issue which was discussed. Again, let's look at the existing framework and the challenges which are there. If you look at the existing framework for IPBB, we have a savings account, a 2 lakh limit. There's a sweep in, sweep out facility linked with the post office savings bank account with no upper limit. Then we have a banking access point, physical post office, smartphones is the way in which these are the delivery channels. We have UPI transactions which are enabled. We have third-party products coming through the insurance companies which are being sold. We have citizen-centric services, child Aadhaar enrollment, Aadhaar mobile update, digital life certificates, so on and so forth, DBT, and Aadhaar-enabled payment system. So this is a fairly strong and robust system which has already been developed and is very much in place. And the idea is, of course, that if we're talking of financial inclusion, we're talking of further financial deepening, how exactly do we take it forward? Now, what are the problems which we have here? There's low penetration of assisted digital financial services in the unserved and the underserved areas. So there are always large pockets of the country which are still not served well by the financial system. So that is something which we could be looking at. Next, we're talking in terms of last mile reach of citizen-centric financial and government private scheme services. A low digital and financial literacy. This is again an ongoing challenge which is being taken on by the regulators as well as the institutions. Banking business is restricted more to individual savings account, a balance limit of 2 lakhs. Important part is we don't have credit facility under the payments bank model. So this is something which we need to ruminate over also. And non-availability of institutional account facility and no credit services except as a channel for third-party use. What are the recommendations which we have out here? One is extension of microcredit in rural areas with new tie-ups with banks and financial institutions. Second, institutional accounts, something which should be enabled out here. Third, we're talking to catering to needs of senior citizens with Grameen Dak Sevak network. This is something which has to be leveraged. Next, we're saying increase transactions in the present tie-ups through improved infrastructure and cash management systems. Fifth, we are saying more third-party tie-ups for bundled insurance products. So today, when we're talking of financial inclusion, it's not just banking. We're talking of other financial services. We're talking of health, assets, fire insurance, crop insurance, so on and so forth. More tie-ups with public and private organizations for the doorstep service delivery. And we can also look at in terms of tie-up with mandis across the country. So again, when we're talking in terms of rural farmers who are having accounts out here, there could be tie-ups along the mandis so that as the sales take place, we're talking of the money being paid into their accounts, and the same amount could also be used when we're talking of their credit scores. So I think there could be integration which could take place between the two. And we can also consider creating an input that can go to the Grameen credit score. So I think this way we'll be able to integrate not just what we're doing for the payments bank, but also in terms of the Grameen score. Third issue was in terms of KYC simplification. Let's look at what are the recent regulatory. Sorry, having a problem with the. Okay. Yeah, the recent regulatory initiatives. The amendment carried out in PMLA by DOR notification 19/7/2024. Let's keep this in mind. Mandatory usage of CKYCR identifier, data updation within 7 days, updation in KYC records with all relevant REs each time data is updated by an RE. This is something which is in place. Second, we have an amendment in the master direction on KYC by RBI making mandatory periodic updation at least once in every 2 years for high-risk customers, once in 8 years for medium-risk customers, once in 10 years for low-risk customers. This is all from the date of opening of the account for the last KYC updation. The recent operational initiatives which were taken, SMSs are sent to customers intimating about download of the KYC cards. So this is to get it over 34 crore have been covered so far. Facility to customers to fetch the KYC card through missed call facility. That's another thing which is going on. We have a uniform CKYC template to capture additional data points for revamping the registry. There is no fee for upload and update. The fee is charged only for the download. So that's a positive thing again out here. And there's awareness sessions of REs for RE staffs at different forums, including the SLBC meetings. So these are efforts which are being Now, what are the issues and challenges? The legal and operational challenges in integration of CKY-CRR with document issuing authorities. So this is something which has to be taken up with urgency. Legal challenges in making available full Aadhaar number to CKY-CRR, that's the registry. Capturing of customer consent in CKY-CRR registry before allowing a download for the record. Due availability of mobile email is not mandatory for CKYC records. So this is the major challenge which is there, since very often we don't have the number, we don't have the email, how do we really contact? Diversity of REs resulting in homogeneity issues. This is because these entities belong to different segments. Everybody has their own data, their own way of reporting. So we have a homogeneity issue which is there. Sometimes the REs may not be having the necessary infrastructure for doing this kind of updation. And last of all, we're talking of quality of data uploaded by the reporting entities, which is not uniform as mentioned. So therefore, there are challenges in this particular area. And the roadmap for implementation. One is development of a risk-based KYC. I think this is something which was already on, something which will have to be taken steps further. The CKYCR registry is proposed to be revamped with the following new features. What are the features we're talking of? Verification, validation of documents uploaded by REs from the document issuing authority. We're talking of the Aadhaar data vault which is being used, capturing of customer consent before download of the record. View only is an access to the customers, face matching for deduplication. So I think this is another initiative which we are suggesting out here. And third, we're talking of update of the KYC record on receipt of update information from Central KYC Records Registry to be considered as compliance of the KYC periodic updation guidelines. And finally, in terms of implementation, we're saying implementation with stakeholder consultation will be carried out, and it will be done with the approval of the regulators. This is, in a sense, what we have summarized from the deliberations which we had today in the morning as well as in the afternoon. Thank you.
Thank you, Mr. Sabnavis. Now may I request Professor Pathare, Director, NIBM Pune, to present the deliberations and recommendations on the sub-theme number 3, rationalization of legal and regulatory compliances.
Am I audible, sir?
It is visible.
Am I audible?
Yes, yes, of course.
Okay. I'm thankful to DFS and Secretary Nagaraju in particular for inviting us for this webinar. Honorable Finance Minister, Secretary and other senior officials and professional colleagues. This seminar in some way we looked into one particular theme, namely sub-theme 3 on regulatory investment and ease of doing business. In doing so, there are 8 presentations, quite dense, each going into details of what could come out from this generalized overall budget proposals. The broad philosophy that comes out from these presentations is perhaps 3. There's a subtext that with sound macroeconomics, citizens' trust, and market-friendly and people-friendly regulation, those 3 are the trinity of transformation to Viksit Bharat. In that sense, sound macroeconomics, while not specifically discussed for these papers, they were all along in the background. So I start my discussion purely as a backdrop on sound macroeconomics, then come to the 4 specific themes that were discussed during the deliberations. Of course, these numbers are known to all. India has been seen as really a growth pole In IMF's January projections, 24, 25, 26, this is among the larger economies. This is the highest growth countries. India's performance in terms of fiscal indicators as well as current account deficit has been under control. And even on a slightly longish period from 2013 to 23, India's growth performance has been exemplary. In this background, if India wants to transform itself to a Viksit Bharat, what are the things necessary? In fact, the thrust of these paragraphs that were deliberated in this particular sub-theme are citizens' trust and market-friendly and people-friendly regulation. What were discussed in particular? 4 themes. The first theme that was discussed related to the pension sectors. There was very 2 detailed presentation by ED PFRDA and MD LIC. This is related to the para 99, which talked of the Forum for Regulatory Coordination and Development of Pension Products. The presentation showed clearly there are multiplicity of regulators, and therefore the need for forum is of utmost importance. At this juncture, the presentations pointed out the key challenges and need for government intervention, the absence of minimum obligatory standards among different schemes, lack of mandatory standards for pension schemes, government intervention needed to ensure inclusivity, barriers to participation due to low awareness, government support required for low-income individuals, and a coordinated effort between regulators, providers, and government businesses. Therefore, the proposed forum could have one. One of the key things that came out from one of the presentations is to develop a national pension policy. And this forum, there was one specific suggestion to develop into a national pension and regulatory council. This forum can support government's objective of bridging pension gap among different segments of citizens. Unified approach will increase the visibility on all offerings, fostering healthy competitions, effective collaboration with government agencies. Integration of systems will enable real-time analysis of pension landscape and thereby leading to informed decision making. There was suggested targeted incentive in the form of tax relief. Another very important suggestion came up. It's like in the line of PMJDY, there could be a Har Ghar Pension Yojana, and that could make really a universal coverage. And the standard mode could be auto enrollment so that whosoever doesn't want to be in this can opt out, and there could be a pension stack as well for all these information. What would be the role of the pension forum? Pension forum could do the following. They can create awareness campaigns, provide data analytics services of participants, design innovative long-term financial products with higher returns that can be used for investment by all annuity producers, non-attachment of family pension and other things similar to MWP Act policies, identify and provide inputs where government intervention is required, and enable new products. In other words, at this juncture, the numbers that we get for pension is pension assets as something like 70% of our GDP. So if we want to improve that, go towards the goals or standards set by the developed nation, we need to do this, and this proposed pension forum would do a lot of things towards actualizing that dream. In general, there's quite a bit of emphasis in this particular sub-theme in terms of regulatory reforms, and the Honorable Finance Minister emphasized in the budget in the last 10 years, and I quote, in the last 10 years, in several aspects, including financial and non-financial, our government has demonstrated a steadfast commitment to ease of doing business. Then she says, we are determined to ensure that our regulation must keep up with the technological innovation and global policy developments. And most importantly, she emphasized a light touch regulatory framework based on principles. And trust will unleash productivity and employment. Throughout this framework, we'll update regulations that were made under Wood laws. There were a very detailed discussion on this, quite dense. For the sake of summarizing, I might miss the trees for the woods. Basically, we are going to discuss 3 specific paragraphs. Para 104, High-Level Committee for Regulatory Reforms, then FSDC mechanism, and then finally Para 107, Jan Biswas Bill 2.0. As far as High-Level Committee on Regulatory Reforms, there were 2 discussants. Ms. Bhuvana Anand from Prosperity and Ms. Nipa Seth from ASSOCHAM. There was a quite detailed discussion. What was one thing was there, as far as the scope is concerned, there is a need to articulate the case for deregulation. And there was one of the discussants made a distinction between a stock problem and a flow problem, and said that solving our stock problem we need to do by evaluating existing union laws, regulations and compliances, and we need to future-proof our institutional checks so that we don't get to say a fresh incremental flow problem. How should this high-level committee approach stakeholders consultation? Of course, the consensus seemed to be multiple stakeholders, broad-based feedback, and phase-wise compilation. How would this high-level committee approach systemic deregulation? They should need to emphasize the importance of deregulation and underscore how allowing people the freedom to solve the social and economic problems are necessary. How should this high-level committee on systemic deregulation approach our stock problem? They should liberalize standards and control and adopt something like minimum necessary, maximum feasible. So it's kind of giving a floor and a ceiling as far as regulations are concerned, set legal safeguards for enforcement, ensuring due process of law, and use-based regulation. There was quite a bit of discussion on MSME specific regulations like GST issues, risk-based differentiation, self-certification, or AI and big data-based inspection. Altogether, this set of things said that the high-level committee has quite a plate to serve in terms of rationalizing and simplifying the regulatory structure. The third issue that came up is the FSDC mechanism. There were 2 discussants. Very rich discussion happened from Janmejay Sinha from BCG and N. Munot from AMFI. In terms of FSDC, what could they do? Of course, one of the feeling was that it needs to be cost effective. Of course, there was a typology was developed, a typology of economic, prudential, and informational regulations. There were discussion on tenets of good regulation, which should be outcome-based, stakeholder ownership-based, responsive, impact-sensitive, clear and consistent, and risk-appropriate. There was some quite rich discussion on principle versus rule-based regulation, and more people, more and more ideas tilted towards principle-based regulation rather than rule-based. And quality of regulation versus quality of enforcement was one issue that was flagged by one of the discussants. A general theme was how to leverage AI and big data. AI-enabled data lake could be thought of, and only then this would be the appropriate regulatory structure for Viksit Bharat. Regulators need to balance growth with risk. Incentives are often against growth. They need to have the growth risk trade-off in developing any kind of regulation. Regulations need to answer certain questions. Problem, the FSDC
This realm could be further. FSDC right now is only for the institutional structure. A proposal was made whether they could be extended to include independent people. There could be review of FSDC, control, directions, permission, and reporting. They need to deal with new trends like geopolitical tension, technology and generative AI, global warming, green finance, data and privacy, global standards. One of the discussants also pointed out, as far as this FSDC is concerned, we need to have an oversight mechanism on the RBI as well. The fourth issue that was discussed is the emphasis on trust, the Jan Biswas Bill 2.0. There were two discussants, R. Pandey from SAM and N. Mahmood from Vidhi Legal. There was a very detailed legalities and other associated, both in terms of instances and in terms of principles. While the general consensus was building trust is extremely necessary, and government has made significant strides in decriminalizing minor offenses through Jan Biswas Bill 1.0. However, still now, something like 7,000, slightly more than 7,300 offenses still on central statutes. Decriminalization efforts must be continued in a systematic, institutionalized, and principle-driven way, with added focus on state laws and subordinate legislation. There was a recommendation of the next step regarding strategy. We need to develop a structured framework of decriminalization and criminal lawmaking to prevent excessive and unnecessary criminalization of future laws, to guide ongoing decriminalization efforts. So in terms of recommendations, there was some sort of introduce a mandatory justice, regulatory, and fiscal impact assessment before passing any law to evaluate the implication of criminal provisions and ensure proportionate and evidence-based legislation. In terms of recommendation, the other important recommendation that came up align decriminalization and deregulation effort, conduct a comprehensive review of various criminal provisions, and establish a clear rationale for criminalization. There were specific suggestions for FAQs for criminal sanctions, move from the role of regulator to that of a facilitator, absence of data, build up the database, number of illustrations have given in the archaic law. There was almost an unanimity as for developing a principle-based framework and rationalization beyond the criminal justice. So all in all, taken together, this sub-theme gave credence to the view that in order to achieve Viksit Bharat, just only the good macroeconomics is necessary, but may not be sufficient. The sufficiency could come from building a trust and having a modern sense of legislations, a modern sense of regulatory structure. I'll stop here.
Thank you, Professor Ray. We have Honorable Minister of State for Communications, Dr. Chandrasekhar Pemasani. May I request him to speak?
Sure, thank you. Can you hear me? Yes. At the outset, I extend my heartfelt gratitude to the Honorable Minister of Finance and Corporate Affairs, Srimati Nirmala Sitharamanji, the Honorable Minister of State for Commerce and Industry, Sri Jitin Prasadji, Honorable Minister of State for Finance, Sri Pankaj Chaudharyji, esteemed secretaries, and all the distinguished participants. Your collective wisdom and commitment to India's economic and regulatory transformation are instrumental in shaping our nation's financial landscape. The theme of today's webinar, Regulatory, Investment, and Ease of Doing Business Reforms, is both timely and crucial. As we advance towards a more inclusive and digitally empowered financial ecosystem, India Post Payments Bank stands poised to redefine last mile financial access. Today, if you look at it, the Department of Post delivers financial services primarily through two yet complementary channels. One is Post Office savings accounts. Second, India Post Payments Bank. While these two systems have traditionally operated in silos, integrating them presents a game-changing opportunity for financial inclusion. As our Honorable Prime Minister Shri Narendra Modi ji often emphasizes, the one government approach is about breaking silos, fostering collaboration, and ensuring that every initiative works in synergy to maximize public benefit. If you look at it, the Post Office savings account commands a massive customer base of almost 35 crores, while IPPB has around 11 crore customers. This was achieved in a short span. So the IPPB aspires to scale this number to 20 crore in the next 3 years. So leveraging the vast network of our existing savings accounts can be a game changer here. Conversely, the savings accounts has lagged in technology adoption, an area where IPPB has demonstrated significant capability. For example, IPPB stands out with the doorstep banking, where the postal staff use handheld devices to open accounts, accept deposits, process withdrawals, and handle bill payments right at the customer's location. Meanwhile, post office savings accounts require in-person visits, with most transactions conducted at post offices. And currently, IPPB can only accept deposits up to 2 lakh, beyond which funds are redirected automatically to post office savings accounts. So by integrating technological advancements, we can provide a single point solution for financial services that is convenient and efficient for our citizens. So the potential synergy has immense benefits. One, unified customer experience. Second, stronger financial inclusion. Third, cross-pollination of products and services. Four, cost optimization and resource efficiency so that we do not need additional manpower. Fifth, technological upgradation and speedy innovation. And finally, trust and transparency. So even within the current frame, even if we cannot do regulatory, even within the current framework, IPPB has so much untapped potential. For example, approximately around 35 central government schemes, only 6 currently route their DBT schemes through IPPB. So expanding this coverage by enabling Aadhaar-enabled payment systems will significantly increase our impact. Similarly, IPPB's share in UPI transaction stands just 3%, whereas the large players like Google, Apple, they all have more than 20-30%. So our goal must be to elevate this to at least 50 to 20% through what we are thinking of DocPay, or forthcoming digital payments app designed to serve even those without postal bank accounts similar to Google Pay. In addition, we can expand our merchant network to achieve these target levels, provide digital platforms in all vernacular languages so that accessibility can be enhanced, and importantly, launch a mission mode training for rural communities to reduce cash dependency and curb corruption. In addition, we should be able to provide high-yield savings products such as mutual funds or index funds via these channels, allowing all our rural citizens to share in India's growth story. So by leveraging each individual DBT amounts along with their savings and insurance certificates, after combining both the savings and the payments bank, we can deploy an automated AI-driven line of credit for every citizen. This allows microfinance to be seamlessly generated in rural villages, drawn upon when needed, and repaid with flexibility, all under one unified system. So by empowering IPPB in these ways, we not only extend financial inclusion, but also strengthen our economy and create lasting socio-economic impact. Thus, I request all the regulatory bodies to take proactive steps in bringing synergy between the two platforms, ensuring seamless and user-friendly access to financial services. So when we design these products, they should be customer, citizen-centric perspective rather than the policy perspective. So this is my request. Let's work together to make this vision a reality. From Department of Post and Department of Communication, we will be doing some of the activities that are within our scope But if the Department of Finance can also see the vision that we're going, it would make a huge difference for the citizens. And I wanted to thank you once again for all the people who are listening. Jai Hind and thank you.
Thank you, Honorable Minister. Now, may I request Mr. Pankaj Chaudhary, Honorable Minister of State for Finance. We can hear you, sir. You can speak. Honorable MOS for Finance, Shri Pankaj Chaudhary, sir. We can see you.
Secretary Nagaraju.
Sir, ma'am.
Can you hear me?
Yes, ma'am.
I just wonder if you're requesting Pankaj Chaudhary ji to say something, if he wishes to say, or is he expected to say. Can we just check up with Pankaj ji if he wants to say something? If not, we can move Commerce and Industry MOS.
All right. Sir, you wanted to say anything?
Pankaj ji, आपको कुछ कहना है? He can't hear. Can you hear me? Others?
Yes, we can hear you, ma'am.
All right. If Pankaj is not able to hear, I wish somebody informs him on the phone and ask him, Pankaj Chaudhary ji ko kuch kehna hai? He's not able to hear. So maybe we can come back to him. In the meanwhile, Secretary DFS can request Commerce and Industry MOS if he wants to start. We can go back to Pankaj Chaudhary.
Oh, ma'am. But we don't have, ma'am, from the DPIC and Commerce.
Is nobody? Then please, can you call up on the phone and expect request Pankaj Chaudhary ji if he wants to say?
I am doing, ma'am. Yeah. May I now request Honorable Finance Minister to give her a message. Thank you.
I hope you've double checked with Pankaj Chaudhary.
I called up PS, ma'am. He is saying that he is trying to speak.
I think you should give him an opportunity to speak.
Okay, ma'am. We'll wait just one
Yes,
minute.
he's putting up his hand. I can see him.
Okay.
Please do ask him.
Yes, sir. Yes, sir. You would like to speak, sir?
वित्त मंत्री एवं कॉर्पोरेट अफेयर्स आदरणीय श्रीमती निर्मला सीतारमण जी, सभी हमारे मंत्रीगण, सभी सेक्रेटरीजगण, उपस्थित सभी बंधु, जिस प्रकार से आज प्रधानमंत्री जी ने वेबिनार में अपने विषय को रखा है और ये बजट माननीय वित्त मंत्री जी के नेतृत्व में जो आया हुआ है, अगर देखें तो इसमें कहीं ना कहीं जो लगातार सरकार हमारी चल रही है उसमें 11वें स्थान से हम 5वें स्थान पर अर्थव्यवस्था हमारी पहुंची है। और 25-26 का जो बजट भाषण था, इसको बढ़ाने के लिए प्रमुख वैश्विक निवेश को गंतव्य के रूप में स्थापित करने के लिए नागरिकों के निवेश और व्यवसाय को करने में सहज संबंधों सुधारों की एक श्रृंखला की घोषणा की गई है। इन उपायों के विश्व मंच पर देश की आर्थिक प्रतिस्पर्धा बढ़ेगी। इन प्रमुख पहलुओं के नाते अगर एफडीआई का सीमा अगर देखें तो 74% से बढ़ाकर 100% किया गया है। वहीं पे कॉर्पोरेट ब्रांड के लिए आंशिक ऋण वृद्धि पीसीआई सुविधा शुरू करना, विलय और अधिग्रहण प्रक्रिया को सुनिश्चित करना, द्विपक्षीय निवेश संधियों को बीआईटी का विस्तार करना और अन्य सुधारों के साथ राज्य स्तर पर एक निवेश मित्रता सूचांक शुरू करना शामिल है। ये कदम व्यवसाय परिचालन को सुव्यवस्थित करने, पूंजी की उपलब्धता में सुधार करने और भारत की समग्र आर्थिक प्रतिस्पर्धा को मजबूत करने के लिए तैयार किए गए हैं। जैसा कि उद्योग जगत के विशेषज्ञों द्वारा आज के सत्र में चर्चा की गई है कि एफडीआई सीमा बढ़ाने से न केवल विदेशी पूंजी या अन्य औद्योगिक आकर्षित होगा, बल्कि बीमा प्रसार से भी सुधार होगा, जिससे आबादी के एक बड़े हिस्से में को किफायती प्रीमियम पर बढ़ी हुई बीमा कवरेज प्राप्त होगी। इस कदम से प्रौद्योगिकी प्रगति के साथ साथ ग्राहक से जुड़ने की प्रक्रिया में बेहतर सुधार भी उम्मीद है। इसी तरह पीसीआई सुविधा कॉर्पोरेट ब्रांड के क्रेडिट रेटिंग बढ़ाएगा, व्यवसायों के लिए उधार लेने की लागत कम करेगी, विस्तार की सुविधा प्रदान करेगी और भारत में के बॉन्ड बाजार से अधिक निवेश आकर्षित होगा। विलय की प्रक्रिया में अगर देखें, युक्तिकरण और प्रतिक्रिया जटिलताओं को कॉर्पोरेट पुनर्गठन से जुड़ी देरी को कम करने, व्यवसाय करने, सहजना में सुधार करने होने की अपेक्षा है। विशेष रूप से बीमा क्षेत्र में एफडीआई नेफ्ट द्वारा क्रेडिट वृद्धि की सुविधा और विलय की प्रक्रिया के सरलीकरण के बारे में आज प्राप्त मूल्यवान जानकारी इन घोषणाओं के लिए एक प्रभावी कार्यान्वयन रणनीति तैयार करने में मेरे विभाग का मार्गदर्शन करेंगे। मुझे आपके सूचित करते हुए प्रसन्नता हो रही है कि वित्तीय सेवाएं विभाग इसे प्रारूप देने के अंतिम चरण में है और बीमा विधि संशोधन विधेयक का मसौदा शीघ्र ही प्रस्तुत किया जाएगा। इसके अतिरिक्त मैं समझ सकता हूं कि नेफेड शीघ्र ही बजट घोषणा के अनुरूप आंशिक ऋण की सुविधा शुरू करेगा, जिसमें इसके उत्पादक डिजाइन और अवसंरचना शामिल है। विलय एवं अधिप्राधिकरण प्रक्रिया को सरलीकरण के संबंध में हितधारकों से गहन परामर्श के बाद कंपनी अधिनियम के आवश्यक संशोधन लागू किए जाएंगे। इस सामूहिक प्रयासों का उद्देश्य भारत को घरेलू और अंतर्राष्ट्रीय दोनों प्रकार के निवेशों के लिए अधिक आकर्षक गंतव्य बनाना है, जो 47 तक अधिक गतिशील, आत्मनिर्भर और विकसित भारत की ओर राष्ट्र की प्रगति को दिशा निर्देशित करेगा। जो प्रधानमंत्री जी का विजन 2047 में भारत को विकसित बनाने का हो, उसको पूर्ण किया जाएगा। धन्यवाद।
Thank you so much, sir. Now may I request Honorable Finance and Corporate Affairs Minister, Srimati Nirmala Sitharaman, to provide us guidance on the budget announcement and today's deliberations. Ma'am.
Thank you very much. Webinars are organized under the guidance of the Honorable Prime Minister, Shri Narendra Modi, on the Union Budget, play a very crucial role in promoting direct engagement between policymakers and stakeholders across the various sectors. The post-budget webinar series has resulted in building synergy among stakeholders. These interactive sessions enhance clarity on budgetary provisions and encourage collaborative problem solving as per the mantra of the Honorable Prime Minister, Sabka Saath, Sabka Vikas, Sabka Vishwas and Sabka Prayas. These structured and thoughtful sessions provide a platform for industry leaders, economists, policymakers experts and citizens to gain deeper insights into the budget announcements, policy priorities, and also economic reforms. Today's webinar, organized by the Department of Financial Services, was on the theme of regulatory investment and EODB reforms, and focused on the parameters that will help promote investments and to improve the business climate in India. Honorable Prime Minister emphasized during the inaugural session earlier today, we cannot be spectators, we have to play our role. This aligns with our commitment to encourage global economic partnerships, leveraging technology to strengthen traditional sectors and significantly enhance the export potential of India. Earlier today, the Secretary, Department of Financial Services, the Chief Economic Advisor, Secretary Post, Secretary of Ministry of Corporate Affairs, and Secretary DPIIT spoke on various issues pertaining to their departments. 3 sub-teams saw 22 panelists and 28 active participants have a structured and thoughtful discussion on the various issues. The discussion was witnessed by a large audience comprising regulatory bodies, senior government officials, companies, industry associations, academia, banks, and sectoral experts, and so on. The highlights and main takeaways of the breakout sessions have been presented here by Dr. Charan Singh, CEO of the eGrow Foundation and former non-executive chairman of Punjab and Sindh Bank, Sri Madan Sabnavis, Chief Economist of Bank of Baroda, and Professor Partha Ray, Director of the National Institute of Bank Management in Pune. Since 2017, the budget has been presented on 1st February instead of 1st March, which gives us more time for the departments and ministries to plan and implement the budget announcements in the same financial year. Our government remains committed to the ensuring of timely implementation of all budget announcements for the year 25-26. This is consistent with our track record of delivering on promises made in previous budgets. For instance, the new MSME credit assessment model announced in Budget 24-25, which is still in the Parliament for clearing, which is the year ending March 31st is just around the corner, has progressed significantly. 11 public sector banks have already operationalized the model for existing customers, and 7 banks have extended it to new customers as well. First, under the Mudra loans, the loan limit under the Tarun category increased from 10 lakh to 20 lakh, with implementation completed via a Gazette notification dated 24th October 24. The second, 21 new SIDBI branches have already been opened in MSME clusters during 24-25, in line with the budget announcement made in 24-25 July. The Ministry of Corporate Affairs has implemented the pilot project for PM Internship Scheme announced in the budget of 24-25, creating over 1.25 lakh internship opportunities in top companies with over 6 lakh applications received so far. Our government remains steadfast in reducing regulatory burdens and enhancing trust-based governance to improve the ease of doing business. Through the budget announcements, we are taking various steps towards making India a seamless, export-friendly economy, one where businesses are free to focus on innovation and expansion and not paperwork and penalties. Decriminalization of business-related laws reduces the legal risks, allowing industries to operate with greater confidence. A robust manufacturing sector free from unnecessary regulatory bottlenecks, will further attract both domestic and foreign investments, driving economic growth, positioning India as a trusted global player. Our government has over 42,000 compliances removed and over 3,700 legal provisions have been decriminalized since 2014. In the Jan Vishwas Act 2023, more than 180 legal provisions were decriminalized. Our government will now bring up the Jan Vishwas Bill 2.0 to decriminalize more than 100 provisions in various laws. It will further simplify processes for businesses. Honorable PM actually referred to these steps which have been taken in his inaugural statement this morning. The pathway for reforms are complemented by the government's unwavering focus on capital expenditure as a driver of economic growth. For the year 25-26, total effective capex is proposed at 15.48 lakh crores, which is 4.3% of the GDP, with 11.21 lakh crores allocated as core capital expenditure by the center, which is 3.1% of the GDP. This unprecedented investment in infrastructure development is already creating jobs, strengthening industries, and laying the foundation for private sector participation in India's growth story. Today's webinar has brought together stakeholders from ministries like Finance, Department of Industrial Policy and also Internal Trade, Corporate Affairs, regulators, state governments, public sector banks, insurance companies, SIDBI, NABARD, and industry associations to ensure smooth policy implementation. Various important inputs have been received during the course of the discussion, and they will be looked into suitably. The inputs will help align our strategies, address possible implementation challenges, and ensure that budgetary announcements efficiently translate into tangible actions. To the stakeholders and experts who joined the webinar today but could not speak, I urge them to send their inputs by email to the department concerned. I thank all of you for joining today and contributing to this meaningful dialogue that will translate the government's vision into tangible outcomes for the year 2025-2026. Jai Hind.
Thank you, ma'am. Once again, I thank all the participants and their respected industry leaders on the budget announcement webinar. And we will be preparing a report and submitting to the government. Thank you so much. Jai Hind.
Team has come for discussing AOC4 and NGT 7.
आप
अमित से बोलो सर, अभी अमित डिस्कस कर रहा है, मैंने अमित से बोल दिया कि यू डिस्कस